we're going to have some momentum here. You have some of the technicals telling you that the market should continue to do well.
Absolutely, monetary policy is biting into economic activity.
The glide path is going to moderate. The question is, can margins be maintained?
We still think that there's some pain in front of us.
I think the end game here is that we'll have a higher inflation target.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is Fed Day, live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures just about unchanged on the S&P 500. TK, its operation stepped down in the minds of many.
I don't buy it. I don't buy it for a minute. We're going to talk. Richard Clarida will join us here on the 1 o'clock hour today on the Fed show, the former vice chairman. And John, to me, looking back, 3 meetings, July 27, September 21, November 2nd, there is nothing transitory going on today.
Starting to see some pain, though. Tom, starting to see it in the data
a
little bit, starting to see it in the earnings just a little bit. But largely globally, you see that in the Maersk outlook, I think, cutting their global demand forecast. What you don't see it in a big way is maybe in the US data. I was looking at JOLTS yesterday. This market flipped on job openings in America yesterday. And Lisa, they moved in the other direction.
Okay, a lot of people are saying, okay, maybe you're not seeing the unemployment rate rise, but you are seeing soft firing or not hiring, right? This is sort of the theory.
Soft what?
Is that soft firing?
Whatever the case may be. The theory here is companies are going to find ways to pare back the number of people that they add rather than wholesale firing. That was thrown out yesterday with the job openings actually increasing. They were expected to keep coming down from historic levels. What does this mean about the appetite and the resilience of business activity at a time which should be slowing? That's the Fed
chart banner. Bring up the banner on radio. This is transitory nominal GDP. This is what John Ferro watches here, and this is the animal spirit of the United States. Come on, John. 11% down to 10%, down to 9%. We have a long way to go where someone like Richard Clarida or Mohammed Al-Arian say, hey, that's on the edge of normal. We're way away from that.
Sure, but we've started to see little signs of it in the ISM and manufacturing yesterday.
It's a slowdown. What'd you call it?
New orders. New orders starting to come in again. I think another sign of contraction on new orders. Prices paid really started to come lower, and we're just about at that line in and around 50. You get a break of that in the next couple of months. I think we'll have a different conversation.
The problem is that all of the industries are facing slightly different outlooks. You point to Maersk talking about a 2 to 4% decline in total shipping activity because just the transatlantic, the international trade picture is dimming. How much does that really represent what's going on domestically, where people are still going out, they're still traveling, they're still gambling, they're still flying planes, and you have the likes of JetBlue's CEO coming out and saying they're not seeing any cracks in consumer demand whatsoever.
Do you have any idea who Chart Banner is?
That is a human. That is a human being.
That's a human being.
Yes.
Okay.
He's
Chart Banner.
He's British. He's from Cornwall.
British, and you call him
it's
Chart
Cornwall.
Banner.
No, that's his mother's name was Chart and his father's name was Banner.
That's a double-barreled name.
Yeah, it's like what do you call that?
A double-barreled.
A double-barreled name. They do that in Britain, I'm told. And
okay.
He was. Then he's he's like Cher. He's so large he doesn't have a first name.
I'm not convinced of this
He's
at all.
offending the person in the control room who's a very talented human being and all Brits, because that's essentially what you guys do.
Chart Banner and I.
Two names.
Chart Banner and I watched 3 seasons of Poldark, front to end. That's how
you
Cornwall
were a big fan
is.
of Poldark, weren't you?
Well, it's very Cornwall.
Yeah.
Like, Chart Banner turned me on to it.
We'll talk about that later.
Okay.
Equities look like this going into the Fed decision. I have to tell you, on the S&P 500, the day before the Fed last met, the S&P 500, Tom, guess where it was? Guess where?
I was going to look and I didn't.
Close to 58.56. Guess where it closed yesterday?
Yeah.
38.56 rather.
Yeah.
So basically, no change whatsoever on the S&P 500.
And I didn't do equities because of that. But, the VIX 26.14, you see the same thing there. What I would look at is the real yield over the last 3 meetings. The real yield has done what Jay Powell wants. It's come in, and that's fine, and we'll see where we are in December. To me, all this meeting is about is December and into January.
The yield's essentially unchanged as well on a 10-year, just north of 4%, 4.04%. Euro dollar, slightly weaker dollar here, stronger euro. Bramo euro dollar 90. 99.08. We're positive about a third of 1%.
To your point, the lack of change in and of itself is really telling because we have not seen a material tightening in financial conditions, even as the Fed tries to get that to happen. So how does the Fed really signal? They want to see a further tightening. They want to see stocks going down. They want to see bond yields stay up. They want to see that ongoing pressure on the global economy. 8:15 a.m., we get ADP employment data today. I'm not going to extrapolate what it means for Friday's jobs report because the correlation is actually getting less tight as a result of some of their new methodology. It will be interesting, though, following yesterday's JOLTS data. The fact that we actually saw an increase, an unexpected increase in the number of openings that employers were offering, were advertising, really signals a lack of tightness, a lack of loosening, in the labor market at a time when that's really what the Fed would like to see. Today, we do get the FOMC rate decision at 2 p.m., followed by Fed Chair Jay Powell, who will be speaking at 2:30 p.m. We are going to be doing a Fed special, a Fed Decides program here. Bloomberg Surveillance always brings that to you on Fed days. Today, a stellar lineup, including Rich Clarida, former vice chair of the Federal Reserve, currently at Columbia University, Diane Swank of KPMG, Scott Meinard of Guggenheim, as well as Matt Lazzetti of Deutsche Bank. How do they talk about the step down? How do you talk about not loosening financial conditions while also signaling perhaps the Fed's getting a little bit closer to where they want to end up because they're expected to end up at around 4% by the end of today, 3.75% to 4% being the range. And then after the bell, earnings do continue. Qualcomm coming out among others, including Zillow, eBay, and Robinhood. How much do we see the chip pressure ongoing, especially as you start to see more disruptions in the manufacturing lines, especially in China? John, did you see about what's going on in Foxconn?
Yep.
That basically that entire region in China shut down as a result of COVID, really raising some questions about the production of iPhone 14 because this is a factory that produces 80% of the iPhone 14 for Apple.
So we've got lockdowns in China again. But Tom, there's this rumor going around that there is this committee being formed to assess whether we should drop COVID zero. And equities in China keep rallying off the back of that rumor.
There's no question. 2 days in a row.
China.
I looked at the technicals on this, and much like here, they've rallied, John, but the damage has been so bad from the summer that you can't say China equities have broken out to some form of new trend. I would note the weakness in renminbi, again, rounded up 7.28, and I'd also note how surgical the lockdowns seem to be. Around the Apple factories, it's, I believe, 7 miles. I mean, they're micromanaging a virus. How do you do that?
The Hang Seng closing up 2.4%. The Fed decision just around the corner. Ron Temple joins us now, the co-head of multi-asset and head of US equity at Lazard Asset Management. Ron, first to you on the December meeting, not the November meeting. What clues are you looking for in that news conference?
Well, I think signaling a pivot in today's meeting would be monetary policy malpractice. I mean, I agree with what Tom was saying earlier. Today is not the day to send signals. I think December 14th is when the Fed would have enough data to give a preliminary view on 2023 monetary policy. And the reason I say that is between now and then, you've got 2 more inflation reports, you've got 2 more jobs reports, a lot more data for the Fed to chew on to see if the tightening conditions is actually having the effect that they would like it to have on the economy.
Ron, I heard yesterday my team briefed me on your appearance here, and the first thing I said was, Ron Temple's on, we've got to ask about revenues. Nominal GDP, 10%, 9%, where we are now, maybe we go to 8%, 7%. Do you assume revenues come down of equities as we get the economy in a direction Jay Powell likes?
Yeah, you have to assume as nominal GDP growth decelerates, you're going to see revenue growth decelerate with that. But you should also see expense growth decelerate with it. And I think what you've seen in this earnings season so far, by the way, is this asynchronous element of expenses going up much faster than revenue in some cases in the tech sector, where companies actually have been hiring, making plans, and frankly, the turnover is starting to change, and maybe they hired a little too many people too early before they basically saw expenses go up when revenues were declining. But I do think as we look forward, very importantly, the Fed really started hitting the brakes hard 4.5 months ago. So this hasn't had time to show up in the broader U.S. economy. And I do think, to John's earlier comments, by the way, we're seeing in the goods sector, we are seeing a deceleration of demand. We are seeing in the last inflation report, goods inflation ex food and energy was 0. The problem is all of the inflation last month was in services, and the service economy is firing on all cylinders. The consumers are spending money. They're transitioning towards services. And I don't think the Fed should signal a pivot until they see that deceleration in service inflation.
Ron, you think that we're going to end up settling at 3 to 3.5% inflation over the next 3 to 5 years. Are we ever going to head back down to 2% over the next decade? And if not, if we end up in this 3 to 3.5% inflationary regime, how does that change what you want to be invested in, how you want to arrange 60-40?
Yeah, I think many of us have gotten used to an incredibly benign environment around inflation. If you look at the decade ended 2019, before the pandemic, inflation on a core basis compounded at 1.7%. I don't think we're going back to that. And there are two primary reasons. One is deglobalization. Number two is climate change. If I look at globalization from 2000 to 2019 in the U.S., inflation for goods, excluding food and energy, was zero. We basically had no inflation for tradable goods, in large part because of NAFTA, because of China coming into WTO, and we got this globalization benefit. I don't think we're necessarily moving those jobs back to the U.S., but I think that kind of globalization dividend is behind us. So I think that's one piece. And the second is we're going to spend trillions of dollars on climate change over the next decades. We're going to have more climate volatility that causes volatility in food prices, difficulties in transportation supply networks. That's all going to require more redundancy. So if you put all that together from an asset allocation perspective, 3 to 3.5% inflation means lower multiples on equities. It means we're going to have sustained higher bond yields, probably means higher spreads on credit. And I think it's also a tougher environment for private equity, which relies on a lot of leverage. I don't think private equity will be a bad investment. I just think the manager selection will be a lot more important. And last but not least, it's probably an environment with a lot more dispersion, should be good for more hedge fund-oriented investments. And also in a higher inflation environment, you should expect infrastructure assets and other real assets to do quite well.
It's a big game changer. Ron, thank you, sir. Ron Temple of Lazard Asset Management. Bit of good news just crossing the Bloomberg comes from Turkey's leader, President Erdogan, saying that the Ukraine grain corridor will resume operations, seeing agricultural commodities respond to that headline, Lisa, just moments ago.
Yeah, wheat futures dropping as people think that perhaps we won't get some sort of fissure in that major wheat trade line.
We'll pick up on that story in just a moment. Going into the Fed decision, equity futures positive 0.1%. Live from New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Federal Reserve looks set to deliver a fourth straight supersized interest rate increase today. Policymakers are expected to raise rates by another 75 basis points. Meanwhile, Fed Chair Jerome Powell is almost certain to repeat his unwavering message on inflation without necessarily pivoting yet. In Israel, the fifth election in 4 years appears ready to return Benjamin Netanyahu to power. Now, exit polls show that his strategy of forming an alliance with the nation's far right has succeeded. The pro-Netanyahu bloc appears to have just enough seats to form a slim majority in parliament. In Brazil, President Jair Bolsonaro has promised to follow the Constitution and ordered the government to start the transition. Incoming leader Luiz Inácio Lula da Silva. Bolsonaro stopped short, though, of conceding defeat 48 hours after the election, but the remarks are seen as a gesture that he will honor the results of the voting. CVS, Walgreens, Boots Alliance, and Walmart have tentatively agreed to pay more than $12 billion to resolve thousands of state and local government cases involving opioids. The suits accuse the chains of mishandling the painkillers, which are blamed for 500,000 deaths in the U.S. over 2 decades. States, counties, and cities still have to sign off on that settlement. The shipping company AP Moller-Maersk is cutting its forecast for a global container market. The world's largest owner of container ships says demand will shrink as much as 4% this year. Maersk says another contraction is possible next year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Folks, this ain't your father's Republican Party. This is a different breed of cat. Just look at the facts. When I took office, the economy was in ruins. This is not because of me, it's because of what I inherited.
President Biden there on the campaign trail, live from New York City on this Fed decision day. Here's the market for you. Equity futures up 0.1% on the S&P 500. Market shaping up as follows, not doing much as you might expect. Yields higher by a little bit. 4.0484% on a 10-year in the FX market. Slightly stronger euro, 99.03, up a quarter of 1%. I think a little bit later we get the ADP report, don't we, Bramo? I think you mentioned the data,
Yeah, does
We're
it
going to ignore that? That's what I was thinking.
I was going to say the same thing. I mean, they just changed the criteria.
Make a big deal of that?
I mean, we're gonna try our best. I don't know if it's going to be worthwhile, but we'll find out.
Clearly at the mercy of the news conference coming up, Tom, a little bit later.
Yeah, there's no question about that. And I haven't even done this exercise yet. You looked at the jobs day, and I've got a working number right now of 196,000. That's still a buoyant statistic.
Was that the president there blaming the former administration for the
I
state of the
that.
economy that
I
he
believe I heard that.
inherited and didn't mention the pandemic?
Yeah, well, small detail.
Sure.
Maybe that'll pass through. Amory Horton briefs us now from Bloomberg, Washington, a correspondent here on a political season. And Amory, I want you to speak to our international audience right now. The Republicans are supposed to win. It's a midterm election. What is the character, the quality of the panic of Democrats?
Well, the panic right now within the Democratic Party, and there's a lot of conversations going on about their messaging, how really in the summer they focused a lot of their messaging following the Roe v. Wade decision, and they were really going to focus, and they were also able to campaign making money and donations on and fundraising on abortion rights. But then obviously when you came into the fall, they started to realize that that wasn't exactly sticking. So they are pivoting and having a message towards the economy, but they're just not able to nail it in a concise way, the way the Republicans have over the course of not just the election campaign, but really over the course of the Biden administration. The Republicans have constantly said, are you paying too much for groceries, for rent, for energy, and do you feel safer? But right now, Tom, one thing we should know for the midterms, yes, the House and the Cook Political Report has raised the projections for Republicans to take the House and take more seats. But the Senate, many are still unsure of how that is going to shake out.
Where's the vice president?
She is in her office, I imagine, this morning, but she will be later today visiting Massachusetts, and they have a push this morning, the administration, about energy and heating pumps in your home to try
Anne-Marie, we're like X number of days from an election. Why are we worried about heating pumps?
Because they're incredibly worried about higher energy prices this winter, especially in the Northeast. We already see inventories are incredibly low when it comes to some types of fuels in some areas of the Northeast, and that could mean a big spike in prices, not just gasoline, but home heating prices, which is why they're going to be talking about this initiative today.
Have you ever watched Veep, Tom?
No, I have not.
You should
I
watch
hear
it.
It's great. People have said that.
You should watch it. The vice president always seems to get the questionable gigs. Should we put it that way?
Yeah.
You know, go and talk about piping and stuff for heating. Anne-Marie, I'm much more interested in the day after the midterms. I think most people are as well. And whether this president turns around and really commits to running again for a second term. Are you expecting that to happen soon after?
Well, there are a lot of conversations within the administration about when that would happen and also potentially who his rival is going to be. I think yesterday, really, you saw that, and it was because the president was in Florida campaigning for the Democratic candidates for governor and also for the Senate, and he said that Ron DeSantis is a Donald Trump incarnate. Those were the president's words. And obviously, he's not just talking about Ron DeSantis as the Florida governor who's also running for another term to hold that position, but that this could potentially be the individual that he faces off with in 2024.
But there is an issue, Anne-Marie, of who the Democrats are grooming to be the successor of President Biden if he doesn't run again, especially given some of his approval ratings and his age.
That's right. The president will be 80 this month. He's celebrating a birthday this month, and he turns 80. So there's lots of questions from Democrats. A lot of them have been vocalized in the public about that there potentially needs to be new leadership within the party. The big question I hear from a lot of people, though, is what's the bench? Who is on the bench? Obviously, the vice president, Kamala Harris, many were hoping that she would take the helm, and others are a little bit unsure of that. So there is a question of who would take on that role. But if the former president, Donald Trump, who in the Republican polls is #1, if he does run again, there's a very much likely chance that Biden will run against him again because he thinks he's the only person who could beat him.
MH, thank you. Dan in Washington, we'll catch up with you a little bit later. Just getting confirmation from the Russian side about the resumption of that Black Sea grain deal. getting that confirmation just moments ago from TASS citing the Russian Defense Ministry on the grain deal. So that resumption looks like it's going ahead. Bramo, we talked about it earlier in the week together, that there was a real risk here that things might go in the other direction. And let's face it, that is good news in the last 5 or 10 minutes.
It's tremendous news at a time when there's food security problems and there's real concerns around the world of what could happen if you start to get some of the main supplies of wheat disrupted. How much does this really indicate that Russia's going to take this off the table in terms of not providing a safe corridor or providing a safe corridor for wheat versus just simply a temporary reprieve?
Tom, you would hope we don't have to deal with this particular issue again.
Well, it's there and it's across the Mediterranean. I would look to Tunisia first, which is where the Arab Spring started, and I'd bring it right over to the challenges El-Sisi has in Egypt. The Egyptian currency, folks, on the Bloomberg terminal, USD EGP is the Egyptian pound. And with the devaluation, John, it's 20 out to 24. So I believe that's a 20% devaluation.
Have you been following that currency pair recently?
I'm on it every day, yeah.
Are you?
Yeah. But you know, we're making jokes about it, but I'm sorry, it's a fixed price in Egypt and their economy is teetering. It's an IMF issue as well. There's many others, there's many more Egypts out there.
You need to watch Veep, Tom. You should watch
I'll get
that.
on that. I'll get on that.
Have you seen that before?
No, I haven't.
It's, often it feels like an episode of that sometimes. You should, and then you'll know what I'm talking about.
Is there a vice president in England?
Yeah, of course. We have a presidential system. Tom.
No, but
yeah,
is there like a vice prime minister?
We just haven't talked about it before.
Is there a
We've got
vice
prime
prime
minister?
minister?
There is a deputy prime minister.
A deputy prime minister.
Yeah, and a vice president.
Not very visible
and a
though, right?
No. We hide them. We hide the vice president and the president in the UK.
No, but the
Evidently
deputy prime minister.
Seriously. Yeah. Ramo, that was good.
Well, thanks.
That
I
was
try.
really good.
I will just say, when you said this about Veep, I was thinking about, being a rookie journalist and being sent out to cover, the Gopher Park or something.
Sure,
And it sort of
exactly.
feels a little like that, which, it's
Although
like...
I've heard those stories about what happened when you did get sent to do those things.
Oh, it was so much fun.
You took them very seriously.
Very seriously. Those are really primo.
And perhaps went a little bit too
deep into them. Yeah, we don't have to get into that.
Let me tell you about the donut shop around the corner.
Okay, I've got
real
deep.
things to say.
100%.
Morgan Stanley and Seth Carpenter coming up shortly. This is Bloomberg. The Fed decision coming up a little bit later this afternoon. Going into that, this is how we shape up in the equity market on the S&P 500 and beyond. Futures basically unchanged on the S&P. Up a little bit on the Nasdaq 100, advancing 0.2%. Basically dead flat on the S&P since this Fed last met. In the bond market, 2s, 10s and 30s look like this. Your 10-year, your 2-year, about 50 basis points higher just before the Fed last decided interest rates. Your 2-year right now, 451.78, around about 10 basis points lower than the high a few Fridays ago. On a 10-year, just north of 4%, 4.0422% on a 10-year at the moment. If you want some price action, it's in the commodity market. Wheat rolling over aggressively. We got this headline in the last 10, 15 minutes or so, Lisa. The Ukraine grain corridor to resume operations, according to Turkey's leader, President Erdogan. It's a big move.
And taking out a lot of the gains that you saw over the past couple of days, and this comes after a lot of fears that you could get a massive disruption to one of the main food corridors in the world. How much does this really mean some sort of softening in Russia's stance versus a temporary reprieve?
Well, Tom talked about the potential political fallout from this, Tom, the consequences if we do have the kind of crisis we're trying to avoid here, and it wouldn't be pretty.
I don't want to speak for the managing director of the IMF, but I would say this is front and center for Kristalina Georgieva because they've got X number of countries where, we don't understand it in America. I'm going to use rice as an example. Food is maybe 3, 4, 5, 8% tops of the American food. In some of these countries, food is 60, 70% of the income.
We saw what happened with the Arab Spring. Tom,
well, that's starting in Tunisia, and of course Tunisia's got its own problems as well. Let us continue with our Fed look. We do this with Seth Carpenter, Chief Global Economist at Morgan Stanley. And what is important to know is upon teaching at William & Mary, he was 5 days a week at Paul's Deli. So we're thrilled that he could join us. Seth Carpenter, forget about the fancy people you talked to at Morgan Stanley. What does this Fed meeting and the 4 Fed meetings afterward, meeting for the troops that walk into Paul's Deli in Williamsburg. What does this meeting mean for the people away from Wall Street?
Yeah, I think the hardest part for people away from Wall Street, people are confronting inflation, and inflation's a really big problem for the average person. You were talking earlier about food prices, and it's really salient, as we like to say in economics. It's a price that people notice. It's a price that people pay attention to. And so what the next several meetings are going to mean is, will the Fed do enough to bring inflation down over the next few years? Because remember, that's their plan, is to have it take 3 years or so for inflation to come back down to the target. Or are they going to do so much that they end up pushing the economy into recession? And I think that's kind of the double bind, if you will, for the average people there who are stuck between needing to keep their jobs on the one hand, but seeing inflation eat away at their purchasing power.
Let's move from freshwater economics down to Georgia. I think of the great Richard Timberlake and all. And the fact is, his gospel was a Fed is in every way ex post. Can a Fed actually get out in front of an inflation vector that they presume to see? Is that a delusion, or can that be possible?
I definitely think it's possible, but it's going to take a bit of luck, right? So what are they trying to do? They're trying to slow the economy a lot, but not so much that it goes into recession. It's going to take some luck. It's going to take what Chair Powell keeps referring to as being nimble, which is to say they're going to have to read the data and ask, are things slowing down enough that we can sit back at this point and just leave interest rates high and let things glide? I think it's possible. I don't know that anyone wants to think of it as a certainty at all.
A single mandate central bank. The reason I use that phrase, Seth, is because Senator Warren and friends wrote a letter to Chairman Powell to close out October going into this decision. And she had a series of questions in there off the back of a series of statements from current Fed officials and former Fed officials as well. Would you describe this central bank as a single mandate central bank at the moment, Seth? And how do you think the chairman's going to deal with these questions in the news conference?
Yeah, so I don't think so. It's not a single mandate central bank at all. I think Chair Powell has been trying to walk a very fine balancing act by pointing out that if you want full employment over the long term and you want to have inflation that's stable, you kind of have to slow the economy down now to put it back on a more sustainable track. So I really do think the Fed is trying to balance both of its mandates. Their last set of projections, like I alluded to before, have them bringing down inflation not next year. This is not 1979 that they're trying to recreate. They're trying to bring inflation down over 3 years. And by doing it over such a long period of time, try to insulate to the extent possible the real side of the economy.
This is a very difficult communication strategy to try to execute right now, especially given that Bernie Sanders and Elizabeth Warren are just the tip of the iceberg of Congress members who are getting very concerned about essentially torpedoing the U.S. economy to bring down inflation, as a lot of people say is what's necessary. Given your 15 years at the Federal Reserve, how are some of these criticisms being received? How are they being addressed in the communication strategy, if not the actions of the Fed?
I think the criticism is being taken very seriously, and of all the news reports that you see coming out of Washington, Chair Powell is a regular feature on Capitol Hill, spending a lot of time talking to members of the Congress. As much criticism as you hear about concern about what's going to happen with jobs, you hear plenty of concern as well, plenty of criticism about inflation being too high. In fact, at a time of political divisiveness, I would say anti-inflation sentiment is pretty bipartisan. I think the real challenge is finding out what is the least painful way of addressing inflation right now.
Seth, do you have a sense of just how much pain would be required, and how has your view evolved as we get data point after data point that shows ongoing resilience despite the fact that we're close to 4% Fed funds rates after today?
Yeah, so very hard to be certain about how much pain is necessary. I think there's no two ways about it. Job growth, we saw the last jobs report at 236,000 or so. We're going to get another jobs report on Friday. I think jobs have to come down much slower than what we've been seeing over the past year or so for there to be a reduction in aggregate demand. And it's true, inflation has been just much more stubborn, much more resilient than I think we would have been expecting a year ago.
And Dr. Carpenter, we at Surveillance are doing a scientific study to see how many of our guests, what percentage, have the copy of Ben S. Bernanke behind them when they're on air, all 624 pages. You're a trophy winner like many of our other guests. Who's the Ben Bernanke helping the Wall Street guy, Jerome Powell. Is Lael Brainerd the Ben Bernanke for Jerome Powell?
That's a great question. And since you bring Ben up, just another congratulations to him for the Nobel Prize. Very well deserved. I have the honor to have had him as my dissertation advisor in graduate school. I think the reality is when you're chair of the Fed, you basically have your pick of everyone. Anyone would be willing to talk to the chair of the Fed. The challenging thing for Jerome Powell right now is to try to synthesize all of the advice that he's getting from all corners. So yes, Lael Brainerd is there. She's vice chair of the Fed. She is a very experienced policymaker. Her advice is almost surely invaluable to Chair Powell. But any academic economist, any Wall Street economist would in an instant take Chair Powell's call and try to give him some advice.
Seth, what was he like as an advisor to you? What was he like?
Fantastic. He's just amazingly humble. Well, it's an amazing combination of being humble and brilliant at the same time. I'd give him chapters of my dissertation, and literally the next day he'd come back to me with comments and be willing to be completely generous with his time. A great man.
He didn't shred them, Tom. Didn't shred the chapters of the thesis.
No,
Seth, that's good. Seth, wonderful to catch up with you. You are humble and brilliant too. Seth Carpenter there of Morgan Stanley. Thank you, buddy. Appreciate it. I think there's a lot of people on that Federal Reserve who believe, and Chairman Powell said it, these are his words, a failure to restore price stability would mean far greater pain. That's something they're going to have to do a better job of communicating in this news conference, given the political pushback of the last month or so.
We will, of course, ask Dr. Clarida about single mandate, dual mandate, and Steve Roach would say there's actually 3 mandates, which is part of this asset bubble that they invented. But the idea for me is ex post, ex ante. I see no evidence that they can, quote unquote, get out front of the debate. It's a parlor game for us, but they are slaves to those reports to the December meeting.
I'd love a fresh assessment on the balance of risks. And just a simple question. The last time they met in the minutes, there was a group of individuals, officials, Lisa, who believe that the risk of doing too little is greater than the risk of doing too much. I wonder whether that's changed much between the last meeting and this one.
Well, and we've heard around the margins, even Lael Brainerd give nod to perhaps this other view, which Senator Warren and Bernie Sanders actually highlighted in their letter, basically saying even on the Federal Reserve itself, there is dissent. How do they represent that, though, without leading the market away from them, right? And this is sort of the one major issue that the Fed has. How do they continue to signal that they are a single mandate Federal Reserve, even as they are not longer term, and they have to cater to that political will?
I won't question the motive behind the letter. Let's just talk about the substance and the content.
Okay.
She thought it was a pretty decent letter.
Yeah.
You know, it's how I would prep for an interview with a Fed official. You'd go through all the recent statements, you'd pick out recent quotes, you'd try and identify some contradictions and look for some clarity. And I think they're worthy questions worth being asked. We just understand also there is a motive there, and we're within a week of the midterms.
Yeah, well, and I'm thinking here, does this mean that you think that you could go into politics? I think that you could do it.
I don't think anyone wants that.
Actually, when there was a question about the Prime Minister, we had a lot of messages saying, you know, is John off because he's running for Prime Minister? And you know, we confirmed on this show that, you know, you were thinking of a run. But
which state would have me if I wanted to be a senator?
I'm just playing around with you, but
nobody would have me.
These are really good questions, and it's important for the Fed to be able to answer them. But are they speaking to the market? Are they speaking to politicians? And can they be consistent in speaking to both?
They're speaking to the electorate, aren't they? You know, right now, the politicians are speaking to the electorate. The Federal Reserve chair is trying to do the same thing in a very different way. I just think there's a lot of people who are utterly unconvinced, Tom, that higher unemployment is a price worth paying to get lower inflation.
Yeah, I see no evidence of that whatsoever.
They've got to attack those questions.
Look, it's November. It's not October. It's November. In transitory was ancient. Alan Zettner, working with Seth Carpenter, evaporated that in February or March. And I'm sorry, inflation has not come down. That's the sum of where we are.
Weren't they still flirting with transitory up until about 12 months and a bit ago?
Yeah.
You know, this shift's not even a year old, is it?
There are a number of economists that are still flirting with it, I would argue.
Yes. We can pick up on that later. Greg Peters got things to say. Joined us from PGIM at 7:30 Eastern Time. Looking forward to that from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. It's decision day at the Federal Reserve, and for a 4th straight time, policymakers are expected to raise interest rates by a supersized 75 basis points to the highest level since 2008. Meanwhile, Fed Chair Jerome Powell is likely to stick to his message that the hottest inflation in 40 years must be tamed. The CEO of HSBC sees a tough year and a half or so for the UK. Noel Quinn spoke to Bloomberg's Yvonne Mann and David Ingles at the Global Financial Investment Summit in Hong Kong.
I think the change in government has really helped the markets understand the future policy. I think there's still a lot of work to do. I think the UK economy is going to go through a challenging year, 18 months. There probably is going to be a recession. How deep, we don't know yet. But it's better today than it was 2 weeks ago.
Quinn also said that China will rebound from the impact of COVID and its economy will reopen at some point. Bloomberg's learned that the U.S. and Saudi Arabia have shared information indicating that Iran may attack the kingdom or other nations in the region soon. That's leading Washington and Riyadh to adjust their military posture. People familiar with the matter say the attacks would be an effort to distract from the recent nationwide protests in Iran. S&P has cut Credit Suisse's long-term rating to just one level above junk status. That underscores the Swiss bank's challenges after it outlined a radical restructuring last week. Credit Suisse was cut from BBB to BBB minus with a stable outlook. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
Will they pull out of COVID zero or not? Well, that's going to have a big leaning really on the market's expectations for growth in China and therefore on the value of the renminbi, because we all know that Chinese growth this year is really disappointing, and we all know that, of course, a weakened economy means a weakened exchange rate.
That was the brilliant, wonderful Jane Foley, the head of FX strategy at Rabobank. Let me tell you, the quote of the day on China came from the UBS chairman, Colm Kelleher, who said the following: "Global bankers are all, quote, very pro-China. We're not reading the American press. We actually buy the China story." Just a remarkable line, Tom, in public at this financial forum.
I agree.
In Hong Kong.
I agree. This is not HSBC, which has a real delicate balance act there with the heritage of the firm. This is a ginormous Swiss bank doing what everybody else is doing. They're on the Pacific Rim. They want to go in, they fail, they pull away, they come back in. It's an oscillation we've seen for years. And right now they are oscillating with a vengeance back toward China after the party Congress.
We've talked about this many times in the past, Tom, and we should do it again. And away from the financial sector, and just think about the multinationals that operate here in the United States and cater to an increasingly progressive consumer base, particularly on the younger side, Tom. And then when they go abroad, they're pandering to, let's face it, I mean, let's be brutally honest about it, they are pandering to dictatorships simultaneously. And I've asked that question over the years whether that can continue, but seemingly it is continuing.
Well, and it's not just UBS, and I think this is important, but you have Morgan Stanley and Goldman Sachs' CEOs also at this conference, and the omission of talking about China's zero COVID policies, the omission of talking about some of the anti-business, international business types of policies from Xi Jinping, just talking about interest rates and inflation highlights that they do not want to focus on this in any way, shape, or form.
And I want to point out before we go to end of current that UBS had outstanding and has outstanding research on Asia and China, led by Jonathan Anderson, who was iconic, I'm going to say 10 years ago. Let's go to end of current right now and advance the story forward as well. And to give us the back and forth, the ebb and flow of what Western banks are doing in Hong Kong. I sat at the Ritz there years ago across the highway, and I said, it's an out-of-body experience. How out-of-body is the experience for Western banks in Hong Kong right now?
So the fact that all these Western banks, their CEOs are in Hong Kong at the moment, Tom, tells you how important both the Hong Kong and Chinese market is for them, right? So the conference today is all about Hong Kong meant to be reopening. That's a whole lot of debate. You can have your views on that. But the point is these banks are here because they know it's a money box, right? It's a gateway into and out of China. And that's what a lot of the commentary was. As you all mentioned there, it was skirting the big political issues, skirting the human rights issues, skirting the issues, of course, in Hong Kong itself. In fact, John Lee addressed the crowd. He's the chief executive of Hong Kong. He's under US sanctions. So all of that was put to one side. It was all about doing business and making money. And when we talk about fragmentation and decoupling, and political tensions. The one channel that's kind of skirted a lot of it so far has been the financial services channel that does continue to grow in China. It is still a big business here in Hong Kong for global banks as well. So that side of it is very much not on the front line of the tensions.
Within the ebb and flow, again, are the Chinese banks, the big banks, I think it's the big four, I'll let you tell me, are they more state-owned enterprise-ish now than they were 5 years ago?
Well, they've always been owned by the government, Tom, as you know, and they always answer to the government. That's the way the banking system in China operates. I don't think there's any indication that they have taken on any more independence in recent years. As you know, if anything, the narrative is the opposite, that the state, the party is in control of everything. The party at the center of everything, in fact, is the line that Xi Jinping has said. So I think those states are, of course, arms and extensions of the government. They do work domestically for the Chinese economy domestically, and they service Chinese business and Chinese interests globally. So they are an extension of the government apparatus.
And I'm going to ask a really dumb question. Is Xi Jinping, did he just signal a truly less global-looking kind of business view, or is it the opposite? And the reason why I ask is because all of the noise around the shutdowns and then the reopening and then what's going on with the iPhone and then some of the rhetoric out of the global bankers leaves a very confusing muddle of whether this is an economy that is still open for business internationally or whether it is closing its doors.
It is confusing, Lisa. You're absolutely right. Sometimes the rhetoric is all about reopening and welcoming foreign investment. We had some of those lines, including from Xi Jinping himself during the Congress. But then, as you've just said, wait a minute, we've got this big Apple iPhone supplier under a lockdown for the next 7 days up there. We know sentiment is so negative towards production in China right now from these foreign multinational companies. But still, we hear talk of expansion. We hear talk of chemical companies expanding in China. There's a German delegation on the way to Beijing at the moment, and that includes leaders of some of Germany's biggest companies. They're going there to talk about ongoing expansion and investment. So it is a confusing story. As we've said before, the best way to think about it, I would say, is sentiment towards investing in China is very negative. But when it comes to the data and concrete action in terms of big factories and companies pulling out of China, we're not there yet, certainly not on a mass exit scale. It is happening around the margins, but not yet on the mass exit scale that the headlines might have you think it would be.
Which perhaps explains the rhetoric that we heard out of a lot of the executives of big banks globally, how they basically were kissing the ring, right? Basically saying we believe in this area and we're not necessarily buying into the negativity that we're hearing outside of China about what's going on. How much is that a prerequisite to do business in China right now?
Doing business in China has always had its own rules of the road, Lisa. Like technically, you've got to be a joint venture, for example, that has been eased up in recent years, but at the very least, you're operating around the local party rules for sure. But on the finance side of it, as we were saying earlier, the banks have probably been having a better run than most other sectors in there. For example, they've been allowed to take over their operations and own them themselves without having to have a joint venture. That's been a big thing for them. The bond market and the equity market has been opening up in China in recent years. And of course, obviously that has enormous potential. Now that story has turned around this year though with the outflows and with the pace of outflows. But the message from Hong Kong today, from all of these bankers who flew into Hong Kong today, is that they've come here to do business and to do business with China, and they're not planning to change that story anytime soon.
And a wonderful reporting as always, Bloomberg's Enda Karen there out of Hong Kong. Tom, we were discussing these rumours about reopening. I think it's interesting right now whether you just ask a guest whether they think reopening in this economy as it stands is positive or negative for financial markets, given the Fed's effort to try and get inflation down.
And reopening into what? Not only the financial part and the economic part, but the new political and cultural part of a new Hong Kong. These conversations that we've had on surveillance over the years with Lord Patton, the guy who had to stand there and give it away with Prince Charles on the whatever the boat was, I can't remember the name, John. But the when you hear the path from Lord Patton and the giving up of Hong Kong to where we are now, we have no clue what Hong Kong looks like 10 years from now.
This is not where they hoped Hong Kong would be 25 years ago or so, Tom.
Oh, yeah, Absolutely.
Not a chance.
Yeah. I mean, is there wistfulness to it? I don't hear it from Steve Major. I think he's our biggest, visceral contact with Hong Kong among our guests, Steve Major with HSBC. And I'll be honest, Mr. Major has some enthusiasm for them coming out of this constructively.
How was Steve? I can't believe I missed Steve.
He was
great.
awesome.
Isn't he awesome?
He was so good.
He turned to Lisa and he said, look, can we talk West Ham? And Lisa said, sure. And said, well, the ham on the west side is better than on the east side.
He actually called me out.
Was that a conversation?
Yeah, it was a conversation.
No, he actually called me out. He said, we started talking about football, and he called me out in air. He's like, you couldn't look less interested if you tried. He said that on air.
I tried, John.
Yeah.
I went down in flames.
I'm sure you did. From New York City this
morning. How about those
Phillies?
Phillies?
On this Fed decision day, how about them? Astros, not looking good.
I think we're going to have some momentum here. You have some of the technicals telling you that the market should continue to do well.
Absolutely, monetary policy is biting into economic activity.
The glide path is going to moderate. The question is, can margins be maintained?
We still think that there's some pain in front of us.
I think the end game here is that we'll have a higher inflation target.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
So let me get this straight. People are hoping, Lisa, that the November meeting is actually the December meeting, and they tell us what they're going to do next month.
And it's going to be a lot less than they've been doing.
That's ridiculous. Live from New York City.
February 1.
Good morning to you. This is Bloomberg Surveillance with Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures unchanged on the S&P, going into the Fed decision a little bit later on this afternoon. Tom, all about the step down.
How do you measure it? What do you do here? What are the calibrations you use as we go to our Fed show this afternoon? John, I'm going to go to the Bloomberg Financial Conditions Index. I believe it's 11 ratios. It's a soup of data, and it's going in Jerome Powell's direction over the last three meetings, from 0.51 negative standard deviation, 0.70, John, now to a stick. And it was worse earlier. It's less restrictive in the last couple of days, but he's got a trend here working for him.
And this is what he wants.
It's what he wants.
Tight financial conditions, and he wants them there for a long, long time. And that's the question for me. Is there scope for a higher terminal rate than the one that is already priced? Maybe, a little bit, perhaps, if you talk to a lot of people in this market right now. Is there scope to surprise this market just by how much they'll stay at that terminal rate through next year and perhaps even beyond? Because, Tom, I'm still having conversations with people who are talking about rate cuts in 2023.
Give me the CPI date again. You know it, I don't. November, what do we see CPI November 10?
November 10th.
November 10th. Frankly, is that more important than the Fed meeting today?
Without a doubt.
It's as Clarida says, and he'll be with us this afternoon, folks, the former vice chairman says it's a single mandate idea. That's all they're looking at.
Elisa, the next meeting is at the mercy of the next two CPI prints between now and then.
And this is the reason why it's unclear whether they can really, with any conviction, talk about the step down.
Do you like how I
Yeah,
whispered
it's
it?
really good. I think it's good.
I
think that you should, hold a torch to your face, right?
Like Halloween.
Yeah, exactly.
Yes.
There we go.
Step down is
exactly.
Step down is calculus for University of Chicago liberal arts majors,
All right.
constitutional law majors. We're not doing first derivative, rate of change, dy dx. Step down.
Is he taking digs at your education?
No, I'm not. Our education's brilliant, but it's like anti-calculus is what we're doing.
I loved calculus. Moving on, though, I do want to just say one thing about some of the interpretations of the data so far heading into this meeting this afternoon. Andrew Hollenhorst of Citigroup just putting out something about the JOLTS job opening, saying that this is not going to let the Fed really let up from their hawkish message. But this, to me, was really interesting. Any signal of a slowdown or a step down will likely be paired with a hawkish commitment to lean against inflation. So how is the offset signaled that, okay, maybe they'll go to 50 basis points, but to your point, they're going to stay at 5%, 5.25% for more than a year?
I heard someone say recently, Powell's best performance of the year was Jackson Hole.
Yeah.
Just keep it really short, pray for no questions and walk away.
Yeah, remember that? We were sitting there.
Is that basically going to be it?
We were
in the freezing cold.
Yeah, we're in the freezing cold. We had takeout from the Pioneer Grill. I'm dealing into my chip beef and toast, and somebody said it's a 12, 15-minute speech. And what were we, minute 8? We're back.
I've still got to do my expenses for that trip. Got to work out that breakfast that you had. that went on my card. Futures unchanged on the S&P 500, unchanged on the S&P going into this Fed decision. Yields unchanged too at 4.0422% on a 10-year, just about holding on to 99 on euro dollar, positive 0.25%. That's a stronger euro, a slightly weaker dollar. Tom, we keep talking about these rumours of China coming back online. Can you imagine where crude would be the morning that happens?
I think this is the number one story here. The smart people, and Ed Morse, we're thrilled he could join us today, who's been dead on about sub 100 oil. How do you get above 100? And the only way I see it is demand lift.
Lisa, Brent crude right now, 94.47.
Yeah, it's been all over the place, but I think it's a really good question. Does China reopening end up being a good or a bad thing for an economy beset by inflation, given that it would be an inflationary impulse? Today, we get a slew of data, including at 8:15 a.m., ADP employment data. Do we care? Does it matter? I don't know, but people do trade it. So from that perspective, it is relevant. It also is relevant ahead of the jobs report on Friday, although correlated, we're not so sure. And it also follows yesterday's JOLTS data. This might be actually the most important data point of the week that we got yesterday at 10 a.m. Eastern. How much does this increase in job openings highlight the problem that the Fed is facing? People are still going out to eat. They're still going and flying around. They're still doing all of these things that require services. And you're seeing people need to continue staffing up despite the desire for perhaps a little bit of a loosening labor market. Today, the key event, FOMC rate decision, 2 p.m., followed by Fed Chair Jay Powell's press conference at 2:30 p.m. If you can't get enough of us, we're going to be back walking you through all of it with some amazing guests. Stay for the guests, perhaps, not necessarily for us. Rich Clarida, former Fed Vice Chair, Diane Swank, KPMG, Scott Meinert of Guggenheim, and Matt Lazzetti of Deutsche Bank, all walking through what is going to happen at one of the most tenuous points for a central bank facing an incredibly difficult moment. And after that, we get Qualcomm earnings, among a slew of others, including Zillow, eBay, Robinhood. Qualcomm really interesting to me, given some of the chip shortages and then the glut and the fact that we're seeing a real deterioration in the outlook by a number of chip makers. John, at what point does this impact Apple? At what point does this really highlight some tension in a broader economy, or is this just an idiosyncratic moment for an industry that really benefited during the pandemic and now is facing the other side?
Lisa, thank you. Let's get into the earnings right now with Peter Oppenheimer, Chief Global Equity Strategist at Goldman Sachs. Peter, everybody's talking about the step down for the Federal Reserve, maybe a shift from 75 to 50 to 25. Can we talk about the step down that you're expecting in earnings, in EPS, going back from 21 to 22 to 23?
Yeah, absolutely, John. I think this is really going to be a crucial factor that investors are going to have to take into account. We've seen some of the optimism building up again about the prospect for the rate rises to start to moderate. But on the other side of that, we're seeing a deterioration in earnings. This has been not a disastrous earnings season, but certainly not nearly as strong as we've seen previously. And the key thing that's happening, and we've been arguing this for some time, is that margins are starting to come under pressure as a result of these higher input costs. And that means that the forward-looking earnings are also deteriorating. Revisions are starting to come down. And I think it's too premature for markets to be really pricing peak interest rates without taking into account the lower earnings and growth that's coming on the other side of that.
Peter, the seismic change for next year is we have a risk-free rate. We have gravity, as Taleb says it. Do you assume more transactions and truly more combinations as stocks, as corporations confront a reality from decades ago?
Yeah, absolutely. This is an overwhelming shift that's happened. I mean, we have to take into account that it was only at the beginning of last year that the markets were only pricing 1 or 2 rate rises this year in the US, nothing in Europe until next year. And we've seen now a whole range of significant rate increases with more to come. And, just over a year ago, a quarter of all government debt around the world had a negative yield. People were paying for the privilege of lending to governments. Now you're getting around 4% for US 10-year treasuries. This is a big shift, and it requires valuations of financial assets to moderate. We've seen some of that, but probably not enough given the scale of that shift in the cost of capital. And that's why we think there's more downside in the near term on valuations and market pricing.
We're talking in general, but I was looking at a FANG Plus index that is down 49% from its recent peak. I mean, some of the declines in specific sectors have been extraordinary. Peter, have we seen the bulk of the pain in some of the high flyers and some of the tech names, or is it still broad-based? Is it really a more general kind of re-rating, repricing that still needs to take place?
Well, I think that what you've really seen is the rise in interest rates hitting the longest duration assets most aggressively to begin with, things like unprofitable tech, which had its rout earlier in the year. Profitable tech companies, cash generative tech and long duration companies had held up reasonably well, but they're now coming under pressure because they are impacted by the gravity of rising rates and indeed some slowdown in their earnings, as well. So I think it's really about the broad index adjusting valuations to levels which are consistent to a new normal in terms of interest rates. Having said all that, what we have seen is a bit of a reversal of that 10 or 12-year trend that preceded this year, where growth was hugely outperforming value, supported by record low rates and phenomenally strong earnings in the growth sectors. This year has been a year predominantly of value outperformance, and I think that probably has some further to go. So the aggregate valuations probably still need to adjust downwards, but we are seeing a shift in the mix. And it's pretty extraordinary that despite the hit that we've seen to some of the really big tech stocks through this earnings season, the broader Dow, for example, has continued to do very well. And I think that's a reflection of this shift in leadership within the markets as well.
I'm so happy that, Peter, that Tom wasn't listening at the end there at all. Peter Oppenheimer of Goldman Sachs. You missed that, didn't you? Never mind. He had this to say about the S&P 500, Tom, on EPS. Here's the quote in the notes. Even if a soft landing is achieved, we expect S&P 500 EPS to grow by just 3% in 2023, a slowdown from 47%, Lisa, in 21 and 8% in 2022. When we discuss the step down, this is the step down that Peter Oppenheimer and the team at Goldman are talking about, not rates, but EPS.
But they're still making earnings, right? And so it's basically how much do valuations have to come in based on the fact that earnings are coming down, based on the fact that real rates are higher, based on the fact that some people are expecting margins to actually re-widen into next year. I mean, it's just a confusion. At what point do we get capitulation if people are already factoring that all in?
When are we starting our World Cup coverage? We're starting that soon?
I think we already started.
Waiting for a cue from you.
I'm waiting for the bracket to go live on the Bloomberg terminal. I'm waiting for that to happen. Yeah. Yes, you're going to do it too. You're going to participate in the moment. Okay. It's a festival
all right,
of joy.
I will. It'll be so joyful.
Road trip Sunday, you and me.
Where to Qatar?
Tottenham, Liverpool.
Hey, that would be cool, wouldn't it?
The day before, yes. I got an engraved invitation moments ago.
That would be
from
very
the
cool.
Antwerp Arms. The bar down the street from
So we'd go
Todd
to London
Stadium.
to watch it at a pub.
They're having fireworks November 5, and then you've got Liverpool
Bonfire
November 6.
night, and then watch the game.
Yeah, I think it's just
that
brilliant.
Is genius.
It's genius.
That's
Thank
going
you,
on your
Antwerp
Amex.
Arms, Tottenham.
And not mine. Did you watch the game yesterday?
No, I didn't.
That was nerve-wracking for Spurs supporters.
I was too nervous.
Futures unchanged on the S&P. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Federal Reserve looks set to deliver a fourth straight supersized interest rate increase today. Policymakers expected to raise rates by another 75 basis points. Meanwhile, Fed Chair Jerome Powell is almost certain to repeat his unwavering message on inflation without necessarily pivoting yet. In Israel, the fifth election in 4 years appears ready to return Benjamin Netanyahu to power. Exit polls show that his strategy of forming an alliance with the nation's far right has succeeded. The pro-Netanyahu bloc appears to have just enough seats to form a slim majority in parliament. In Brazil, President Jair Bolsonaro has promised to follow the Constitution and ordered the government to start the transition to incoming leader Luiz Inácio Lula da Silva. Bolsonaro stopped short, though, of conceding defeat 48 hours after the election, but the remarks are seen as a sign that he will honor the results of the voting. S&P has cut Credit Suisse's long-term rating to just one level above junk status. That underscores the Swiss bank's challenges after it outlined a radical restructuring last week. Credit Suisse was cut from BBB to BBB- with a stable outlook. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Special coverage of the Fed Decides coming up on Bloomberg Surveillance a little bit later this afternoon. Do not miss that. The former Fed Vice Chair Richard Clarida joining us once again. Looking forward to it. Going into it, equities shaping up as follows. Unchanged on the S&P, on the Nasdaq firmer by a couple of tenths of 1%. In the bond market, 2s, 10s, 30s. It looks like this in the bond market. On a 10-year, about 50 basis points higher than where we were the last time the Federal Reserve met. On a 2-year, as well, about 50 basis points higher. Tom, right now on a 2-year, 4.52. On a 10-year, 4.0.
Quickly, John, we got to get to Greg after Lisa, but the sum to me is we're spinning our wheels in the bond market. You know, I'm not the sophisticate here. But in the last week or two in the bond market, it's sort of been a churn.
Two Fridays ago, we cut through 460 on 2s. About 430 on a 10-year. We've backed away big time on the 10-year in the last couple of weeks. Last week was a big weekly move lower on 10-year yields. But I'm with you the last couple of days, Tom. This bond market's just been all over the place, though, over the last few months. Going to wrap it up in the commodity market for you. Wouldn't typically talk about this, but you've got a big move in wheat. Wheat is lower, negative by 5.8%. And the good news, the Russian Defense Ministry confirming it's resuming its participation in the Black Sea grain export deal. Tom, so getting those exports of grains out of Ukraine into the Black Sea and out to the rest of the world.
It's a big deal. And again, this goes back to what we've all learned since February 24th is the place of Ukraine in grain agriculture. It's dominant.
Massively so.
Massively so. I did not know.
You mentioned the likes of Egypt, a lot of countries, Tom, that are very, very reliant on that food stuff getting to them.
I listened to Eric Martin of Bloomberg News, who's got this nailed, and it's tangible and real. There's no question.
Couldn't agree more
about that. We're going to do equities here?
Hopefully. We're going to do that with Lisa, aren't we?
Okay.
Yeah.
You know,
I just thought you might have things to say.
No, I don't. I'm waiting for equities here because I think it's part of the story.
I thought you might maybe respond to a question we asked 20 minutes ago.
No, I'm working on that. But, you know, I do, you know,
Peter Oppenheimer mentioned it. It just totally lost on TK.
He was talking about the Dow and
Wasn't
how
listening.
it's been really important.
He was doing his World Cup bracket.
All right, let's talk about some of the stocks.
Yeah, I got Italy here.
So,
I got Italy. Where's Italy?
That's a low blow. That's rude.
Yeah, well, so just looking at some of the single name stocks, Airbnb I think is interesting. They disappointed after the bell yesterday with the outlook for bookings in the fourth quarter.
Wait. Is Airbnb done as a thing? Help me here.
Well, I don't know how much of Airbnb's disappointing outlook for the fourth quarter is due to a lack of people traveling around domestically to places outside of big cities and more going to big cities and going international or traveling for work, or how much is because people are going back to the office, right? And they're actually not able to go and work from Honolulu for a month, which sounds fantastic if you could do it. But, you know, how much of that is what's going on? I'm just suggesting.
I wish I had done that.
I wish I had too. I'm completely jealous.
Set up a TV studio on the beach. I wish I'd done
from the
that.
peak down 48%.
I really regret that. I regret that.
You know who did that? Leon Cooperman.
He did do that, didn't he?
That was a Zoom backdrop. I think that we established.
No, Leon told me you could hear the gulls.
Yeah, that was a Zoom backdrop that his son had done. I swear.
I was fooled.
Oh, all right, let's move on.
I thought that was an actual beach.
We'll get confirmation. I asked him. He said his kid put it on and he didn't know how to take it off.
Okay.
Okay, moving on. So Yum intraday missed estimates. Just taking a look at some of those shares, also falling after disappointing earnings. Interesting to see. Although actually they're up now about 0.75%. It's because of KFC. They disappointed dramatically. Their returns did not work, and it was because they exited Russia. That's their explanation. But Pizza Hut did well. So if you look at some of the granularities, Canada Goose falling. You guys are not interested at all.
Got that right. Daylight savings time. Continue.
Which we gained an hour, so I was ranting for the wrong reasons.
Yum Brands is falling back.
2.4% loss after cutting their outlook on the economy, yes, but also because of China. And it really highlights the uncertainty that you've seen in a number of companies with respect to FX headwinds and China, one of the major markets, an unclear outlook there at a time of lockdowns, Tom.
Very good. Greg Peters joins joins us now. This is the conversation of the day in fixed income. Greg Peters is co-CIO at PGIM Fixed Income. Greg, I got a bigger question, and I know we got to do the Fed stuff as well. In the bond losses that you and I have never lived that we've seen this year, yield way up, price way down, has it changed how pension plans think forward? Have the bond losses adjusted the actuarial assumption forward?
Well, Tom, I think it's a situation of good news, bad news story. And so the bad news, the losses, clearly, some of the losses on the bond side are really eye-popping. 20, 30 type of percent numbers that I didn't think I would see, nor pension funds would consider seeing. But the yields are higher. So, you go back to the world when we were at a 50-year basis point, 10-year, negative rates in Europe. That was a far more bleak outlook for pension investors and alike. So the repricing is historic, dramatic, painful, but the destination at higher yield is a much, much better place to be. So it's a classic path destination problem.
Greg, I've been talking to a lot of people about this, and I'm still waiting for a really, really good answer. We've just blown up 10 years worth of QE, zero interest rates, and in many places negative rates as well. I just struggle to believe, and I think many other people do too, that this is it, that this is the extent of the carnage that you get off the back of doing that. Does that resonate with you at all, Greg?
It does, but then I look at the numbers, and the numbers are really quite extreme. So, but I think what you're getting at, Jonathan, is this short burst of pain over? And I don't think so. I think there's a secular readjustment here. I think this is just the beginning stages, and it's not going to be the same type of volatility and the same type of losses. I'm not suggesting that. But to your point, this is an unwind, right? And so it's very Newton-esque, where you have to expect the opposite and equal reaction after QE with QT. And I think we're moving into this phase where central bank dominance is no longer the driving force in financial markets. And all else equal, I think that's a good thing. I think you'll see more rational price action. I think you'll see investors not being so forced out the risk curve in areas that they were wholly uncomfortable. So I actually think we're in a much better place on a go-forward basis than where we were.
That might be the case, Greg. But just to follow on to the point that Tom and John were both referencing about the pain and whether it has been commensurate to the regime change that we've seen with higher interest rates, how significant will it be when the private credit markets reprice? How significant will it be when the maturity wall starts to really get closer and you start to see companies that enjoyed 4 or 5% benchmark rates suddenly have to pay 9, 10, 11%?
So I think you're on to something, Lisa, on the private credit side. So what you've seen during this QE era with zero interest rates is that investors, got yield or extra spread any way that they could get, and that was in the private credit markets, just privates generally. So the interesting artifact about privates is that they don't get mark to market, so you don't see the same kind of volatility. Very much a don't ask, don't tell type of policy. So once you start to see those losses come through, if indeed you do see those losses come through, then I expect a lot more volatility. But on a go-forward basis, once again, I don't think there's going to be the same need for pension funds and others to go out the risk curve, including privates, as I think the preciousness of liquidity, albeit fragile, of course, in public markets is still better than privates, starts to rule the day.
Are you saying, Greg, that you think that entire swaths of the private credit, of the private asset markets, I don't want to say will get eliminated, but will get decimated and will not necessarily recover because of the new income found in public markets that are more transparent and that are more liquid?
Well, I'm not sure it's that dramatic necessarily. It's somewhat of a change, but the demand side, the demand over the past 10 years, the past 7 years on the private asset front has just been dramatic. That's where the growth has been, right? You look at just the high yield market, that has shrunk, right? You've seen levered loans increase, which is kind of the next step to privates and very blurred between the two. But yes, I think you're quite right. I think the need for investors to move into illiquid assets to get that additional spread just is not what it once was. And I do think there is a secular shift. And what happened in the UK on the LDI side is a wake-up call for lots of these pension funds, which is to say, we can't have such a large proportion of our portfolios in illiquid assets.
Greg, I'm not accusing you of anything, but do you think, and I hear this a lot of people in the fixed income market, that we're blinded by hope here, that we hope this is a new regime we're moving to, as opposed to it will be a new regime?
I actually see it differently. I think investors are hoping for the good old days. I mean, you look at how the markets and investors have really been kicking and screaming the entire time around higher rates, dealing with inflation, Fed put, all these types of narratives that were quite prevalent, the past 10 years. So I actually see it differently. And maybe I'm overly hopeful because I am an active fixed income manager.
Precisely.
But I do know this, Jonathan, is that higher yields, all else equal, is better than lower yields and negative yields.
Yeah.
And so just from that simple premise, I think we're in a much better place.
You won't find opposition to that here. Greg Peters, thank you, sir, of PGIM Fixed Income. It's just a divide that I've recognised over the last several months. If you speak to a lot of people in the equity market at the moment, they want to go back to the good old days, pre-pandemic. Low rates, low growth, low inflation, long equities, long growth, long the S&P, passive, all of that good stuff. Lisa, you speak to people in fixed income, they are hoping this is the new normal because this is a better world for a lot of people invested in fixed income.
Yeah, it is. You're getting yield. I mean, all of those years that people were decrying this low yield environment of zero rates and no compensation and a lack of rationality, it would be hypocritical not to be somewhat excited to look around.
When high yield is actually
high yield.
High.
Yeah.
That's somewhat helpful, Tom,
They
when that's the
booked
case.
The losses. I agree the yield's there. I agree cash has value now. Certainly I'm living that with a triple leveraged all cash fund. It's really had a good year. But John, I kid you not, it's about the bond losses we were talking to Greg Peters about before we went on here. Thank you for bringing up daylight savings time. I've learned a lot. I'm researching.
Anytime.
Ben Franklin.
What are you learning?
Franklin, 1784.
It's
we
his
need
fault.
to conserve candles. That's where this started.
It was Franklin's fault.
It was Franklin was the first one who wrote about this.
Do we then change it back because they need to conserve electricity and not end up to turn on the lights in
And this is what I grew up with as a
Nice.
kid on the farm. This
Nice.
comes from Purdue
Full circle.
University in West Lafayette. Cows don't change when they milk. They don't care about the clock. And there's a lot of research on this at Purdue that cows don't care about daylight saving time. Rachel, thanks for that from Purdue.
You know that people believe there's some kind of PDF out there on the internet.
I had no idea. I think, thank you, John, for bringing that up.
Ed Morse is going
I
to join
nailed
us
it 20
from
minutes
City
later.
shortly on the oil market. Boiler up. Isn't that what they say?
That's what they say.
From New York.
I think this year maybe in football.
This is
they're not
Bloomberg.
boiling up.
Keeping you up to date with the news from around the world with the first word, I'm Lisa Mateo. It's decision day at the Federal Reserve, and for a fourth straight time, policymakers are expected to raise interest rates by a supersized 75 basis points to the highest level since 2008. Meanwhile, Fed Chair Jerome Powell is likely to stick to his message that the hottest inflation in 40 years must be tamed. The CEO of HSBC sees a tough year and a half or so for the UK. Noel Quinn spoke to Bloomberg's Yvonne Mann and David Ingles at the Global Financial Investment Summit in Hong Kong.
I think the change in government has really helped the markets understand the future policy. I think there's still a lot of work to do. I think the UK economy is going to go through a challenging year, 18 months. There probably is going to be a recession. How deep, we don't know yet. But it's better today than it was 2 weeks ago.
Quinn also said that China will rebound from the impact of COVID and its economy will reopen at some point. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
They're basically kind of fumbling around in the dark without a flashlight, I think, when it comes to how to be more effective with energy in a geopolitical sense. This whole price cap on Russian oil globally is really sending a lot of confusing messages.
I still don't understand that price cap. I still don't get it. Maybe Ed Morse in a moment can explain it. Ellen Wald there, Senior Fellow at the Atlantic Council. It is Fed decision day. Here's the equity market. Equity futures shaping up as follows on the S&P 500. Not much movement, not much price action. Up a tenth, almost, on the S&P. Elsewhere in the bond market, yields going nowhere. Your yield on a 10-year, 4.04%. And euro-dollar just about going somewhere. Was at 99 briefly, now at 98.97. I guess you can call that 99, that currency pair. A firmer euro, Tom, by about 0.2%.
Yeah, we haven't talked enough about this. 111 on DXY. The dollar really hasn't pulled back from a 112 DXY.
Think about the range we've had, though, TK. I'll just bring up sterling quickly. Cable, 115, right? 115 today.
Yeah.
High of the session, 115.27. The low, 114.75. 103.50 at the end of September. So we've taken a lot of heat out of that game in the last couple of weeks.
Right now, for Global Wall Street, lean forward because Edward Morse joins us. He's Global Head of Commodities Research at Citigroup. Priya Misra of TD Securities, I think of with the real yield. John, there have been other calls that we've seen through the year. Mike Wilson in equities. And Ed Morse nailed oil. There's no question about it. When it was over 100 a barrel, he said, no, maybe not. And here we are under $100 a barrel. Ed Morse, to cut to the chase, if China reopens, many say that will give a demand that will get oil back above 100 a barrel, even to 110, 120. Do you agree?
Actually, we don't agree. It depends on a lot of other things. The only way to get oil back to 110 or 120 is to have a bunch of supply disruptions from places like Libya, Nigeria, and maybe even Iran and Iraq. It's a supply side phenomenon to get above. And yes, we have OPEC Plus thinking that they need to put a floor into prices and they can work at that a little bit. But no, China demand coming back will, of course, have an impact on the market. But we're in a world where demand is sloshing downward around the world, whether you look at the US or Europe. And China, is the third biggest economy in the world, had low demand. But look at where they've been in the last 2 months. Since the middle of the summer, they first went up 1 million barrels a day on imports. Now they're up 2 million barrels a day on imports. And we're having oil since the last OPEC Plus meeting, in a sideways little dance. It's not going anywhere. So I think there's ample supply in the market for us to not have a big impact from China coming back.
So, Ed, why are we draining the SPR? Does that make sense to you?
I'm on the side of those who think these are unusual times. We're actually in what Fiona Hill, as you know, calls World War III. And the instruments are basically economic instruments. Some of them are used foolishly, like the price cap that you were just discussing. Some of them, I think, are a bit wise. And let's look at the SPR. So if we look at the world to date, we've had an inventory build year to date. That inventory build accelerated, and now the inventory build, as we measure it, is bigger than the SPR release. So the SPR release was there to tide over times when we had a first warfare reaction to Russia and Ukraine with oil embargoes imposed on Russian oil, and there was a bidding up of the price of Brent and WTI as a result. We have another potential round of that coming up by December 5th, which is associated with the potential oil cap or the price cap. But we're going to have this bidding up already, and we're already seeing the bidding up. And the SPR is playing an important role in it. So we have so far in the world year to date, as of the middle of last week, to the degree we can measure it, an inventory build of some 112 billion barrels. And the SPR is a big chunk of that. Well, actually, the build has been 273 million barrels year to date. The SPR is 230 million of that. But if we look at the last 2 months, forgetting about the SPR, on a combined, from September to the middle of October, oil on land has risen by 30 million barrels, but more tellingly, oil in the water has risen by 82 million barrels. It's oil in transit. And a lot of that is coming actually from the U.S. The last week's data printed a U.S. export number of an astonishing 11.2 million barrels a day, the highest on record. And we've been, playing with 10 million barrels a day for the last 3 months. So the U.S. has really been supplying the world and taking the edge off of what would have been, a difficult distortion with the Yeah, go ahead.
Well, yeah, with the conflict that we saw over with respect to Russia invading Ukraine, given that backdrop, do you think, Ed, that we're ever going to get back down to that $72 a barrel kind of level that the U.S. administration has said they would really start buying barrels to refill the SPR? Are we going to get there in the next year, for example?
I think we could get there. It depends on the nature of the recession and how reactive people are. We have to remember that this is a world with a lot less open interest in futures and options than we had before. So volatility levels are, very high, and we have $10 or $15 moves that have become the normal in this high volatility world. So I would not exclude $70. I would also note that the administration has not nailed a particular number. They're giving a range. That range is in the kind of 60 to 80. You get to 70 by looking at a 60 to 80 range. And the intriguing thing of this is that we have a U.S. government range that, averages, as you say, $70 for buying SPR to put a floor under prices. And we have OPEC, where it's in the $85, $95 range. It's intriguing that China also has a range with a bottom and a top, and they activate policies. If oil gets below or above that range, they buy for strategic stocks, but they freeze prices at home, or they sell strategic stocks by freezing prices at home at the upper level. So, we have sensitivity now to not going back to negative pricing, not going back to, $20 pricing because of what it does to the production side. It's kind of a new world when you have the largest economies, along with OPEC Plus on the producer side, and by the way, the largest oil producing country, namely the U.S., thinking about what the floor ought to be.
All getting in on a game. Ed Moss, a Citi, one of the very best. Ed, thank you, sir, as always. Brent crude, 94.76, up about 1/10%. WTI this morning, Lisa, up 1/10 also, $88 and about 50 cents.
The range of views on crude and just the path ahead is sort of shocking to me. I mean, honestly.
But there's not a range of view out of 1600 Pennsylvania Avenue. They have certitude this is what's going to happen. What a bunch of baloney. That was the real world.
Certitude that what's going to happen?
You got Ed Morris disagreeing with J.P. Morgan. You got Citigroup disagreeing with A.G. Morgan. No, I'm serious. I
know.
They're disagreeing with each other. This is the way the real market is. Jeff Curry gentlemanly disagrees with Ed Morris, on and on. Amrita Sen and the rest. And at the White House, they're micromanaging oil down to $5 a barrel 12 months out.
It's a tricky moment.
Are you okay there? I mean, that's what they're doing.
I just love how fired up you are. I'm on the same page as you.
Well,
Whenever
that's
I
rare.
get fired up about this, you usually
Where
tell
is
me
the
to back
World
down.
Cup bracket? I'm looking here. Where is my World Cup bracket?
I'm finding out when that's going to go live.
I did World Cup
Hopefully
Italy,
I get
and
an
the
answer
search didn't come
in just a moment. I'm just pleased you're engaged again.
Thank
this
you.
is good.
I'm so engaged.
There needs to be a recession for the Fed to actually hit its inflation target.
The Fed, in our opinion, is nowhere near the end of raising rates.
The Fed is obviously eager for a downshift at some point.
The challenge of the soft-ish landing is so intense because there's a lot of things that have to go right.
If the Fed were to ease up, I think it would be a relief to a huge amount of economies around the world.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. We welcome all of you on Bloomberg Radio and Bloomberg Television. It is Fed Day. It is November, and an unusual November, to say the least. John, this is a Fed Day in November. We're staggering 2 inflation reports out to the Fed meeting in December.
November 10th, December 13th. A lot's going to be said between now and the next Fed meeting, but the next Fed decision in December is at the mercy of those 2 prints. We can have a big conversation about a step down from 75 to 50. You get upside surprises, November 10th, December 13th. Bramo's with me. You're going to have a very, very different conversation.
The heart of the matter, and I remember this at an Economic Club of New York speech by Stanley Fischer, then with the government. He talked about ultra-accommodative, and we've clearly moved to accommodative. And the debate with Richard Claret and others today at our Fed show is the idea of what level of neutral are we at now. I think we're distant.
So Rich Claret, the former Fed vice chair, rather controversially in the last couple of months said it's a single mandate central bank. Senator Warren and others have picked up on that and have asked Chairman Powell, is it a single mandate central bank? The question we've got to ask is, when is this dual mandate in conflict? Because right now for them it's not. Inflation is still delivering upside surprises, and the labour market, when you look at the jobs market on Friday, so far, so good. The conversation we're having is, hold on. Look elsewhere, and you can see cracks all over the place. Shouldn't you start to slow down and appreciate the fact that you've done a whole lot in a short amount of time, and that tightening is still going to come through the pipeline?
Lisa, is he going to talk about 11% food inflation? Is he going to talk about a pound of hamburger, a price of milk, a barrel of oil, or that? I don't think he'll get that granular.
Well, if he's talking about a one mandate kind of Fed, he will be talking about all of these things and how destructive it is for households at a time when their focus for longer term is employment that is stable, and that requires price stability, right, to this sort of point. But at what point, to this issue of how much pain in the cracks forming around the world, are they going to emphasize that perhaps there are signs of deceleration around the margins that they need to pay attention to, because maybe they are just as wrong with the pace of the disinflationary impulse as they were with the pace of the inflationary line?
You two watch the parlor game way more than I do. How close are we to 75 now and 75 in December? I think we're closer than we think.
It's highly dependent on what the CPI prints are between now and then.
You really think so?
Highly dependent on that. The issue that I think they have today is that if they start to signal a step down, do they trigger a premature easing of financial conditions, which would require them to go higher than they otherwise would have had to in the December meeting? And this is the game right now with financial conditions. And I think you're right to call it a game. It is a game. It's a game right now. They've been trying to game financial conditions all year.
We mentioned in the last hour how it's gone in Powell's direction on restriction. But, John, the Bloomberg Financial Conditions Index, to start the data check, negative 0.965. We've moved through one standard deviation up into a less restrictive environment just in the last week.
Well, the last couple of weeks. If you go meeting to meeting, the equity market is dead flat. From the day before the last Fed meeting in September to the day before this one, just yesterday at the close, it is dead flat on the S&P 500. That's why it's sharp. Well, but in the last couple of weeks, it's started to ease on this conversation, and I think we've done this about 5 times in 2022, that the Fed is going to back down and slow down.
Lisa, I thought they weren't supposed to move around an election. Wasn't that like canon, like long ago?
That's dead and buried.
Well, I mean, how could they not, right? But then the fact that you're going to have the Fed, that an election, and then the CPI report highlights the uncertainty of portraying what's going to happen in December, given what needs to happen before that.
We elect to do a data check. John, why don't you kill it with a data check? You don't need to do the Dow.
Was that sincere?
Yeah.
On the S&P, up a little more than 1/10 of 1%. If you've got to ask, it's probably not right.
There you go.
Probably.
Yields down a basis point on a 10-year, 4.0277%, 50 basis points higher on a 10-year than where we were the last time the Fed met. Similar move on a 2-year, to be honest with you. Just off the highs of the year, though. That was a couple of Fridays ago at about 460-something. Can the FX market back at 99 on euro dollar, 99.03, positive 0.25%. And we're glued to crude, $88. And about 70 cents, up 1/3 of 1%, Tom, on WTI this morning.
94.98 on Brent. Thank you, Ed Morse, for wisdom here on lower oil, or quiescent oil prices, I should say. Right now, we're going to frame the morning and frame the afternoon with the Fed with Daniel Morris, Chief Market Strategist, BNP Paribas, who can synthesize what Powell means for asset allocation. Dan Morris, can Jerome Powell change your asset allocation today?
Well, if there's one person that can, you guess it would be the Fed chair. Certainly, it's going to have a big impact. It always does. But at the same time, the Fed doesn't want to shock the markets or scare the horses. So we're not anticipating any big surprise. We are looking at 75. And I think, if anything, the message that the Fed is going to want to convey, and you were talking about financial conditions, it doesn't want to see the market get ahead of itself, that they start loosening too much. We see a big rally in equities. That's not going to help the slowdown in the economy that they're looking for. So it'll probably be an attempt to moderate that perhaps premature enthusiasm because we still have a ways to go before you really get to a point that they are going to actually pivot.
Down in the middle of the summer, in June, and again in October, we were often talking about the Fed put. Where's that bite point that this market goes too far for this Fed? I think we've got to think about it the other way now still. Dan, where do we think about the equity market rallying too much? Is this it? Is that a game that you play? How do you think about that?
Well, I think in terms of playing that game, I think it's a challenge. We still always want to focus on what we think are the fundamentals in the market, what the outlook is, which brings us back to we still see a recession in the U.S. next year, and that's got to be reflected in earnings, which are still looking for earnings growth in 2023, and that's not really a compatible picture. So yes, there's the timing, it's the momentum around anticipation of the Fed, but we want to step back and look at that medium-term view.
So the medium term, are we looking at a 3.5% inflation rate for the next 3 to 5 years, as we were talking about earlier in the show? Is that basically your base case as you come up with some sort of thesis in a new yieldy regime?
I don't think we would see it quite that high. And if you look at inflation expectations, it does show it getting back to, actually fairly close to 2, let's call it 2.5 in a year or so, which does go back to this continued credibility of the central banks, which means that the market believes they will induce a recession, stick with a recession, not back down, if that's what it takes to get inflation back to target. So we think that narrative is the right one. If that's what it takes, the central banks will do it, but that's what keeps those inflation expectations anchored.
Dan, have you ever been in a circumstance where the bigger parameters of the investment thesis are less agreed upon?
What do you mean exactly?
I mean that basically we're talking to people about whether inflation's going to be stickier for longer. We're talking about whether the Fed will be able to go through with inflicting the pain required for inflation to slow. All of these questions that every person on this show come on and they disagree about in terms of the parameters for coming up with some thesis for their investments. I'm wondering whether you've ever seen this before, where the parameters are so uncertain as to where we are in the inflationary regime.
Well, I guess if you think everything that's happened since the global financial crisis, are we any more or less uncertain than we have been at, many times over the last 15 years or so? So I agree there are some, pretty clear fundamental discussions that we're having if we think about, the bond bull market that you've had for 50 years, and that's ending. That's not been particularly pleasant. That's not a surprise, but how far it's got to go. I mean, you're right. These are very fundamental issues that, to be honest, including the central banks, no one has a whole lot of clarity on.
Dan, if you've got a favourite trade right now, you've got a conviction view anywhere, what is it?
Probably highest conviction would be, on one hand, an underweight to Europe ex-UK equities. I think what we've seen on one hand, we're all aware of the threats that are out there, the worries going into the winter. And then you offset that with what are still quite robust earnings expectations for this year and next year. So there does still seem to be a disconnect between at least what analysts are expecting companies able to produce and what we see in terms of the reality on the ground. Gas prices up 8 times from where they were in 2019. An ECB that is equally as hawkish as the Fed, you can argue, maybe a bit less after the last meeting, but nonetheless, they're also going to stick to their guns. That seems to be the biggest disconnect and the likely change for us from here.
Hey, Dan, wonderful as always. Dan Morris there of BNP Paribas Asset Management. We got a flavour of this from Maersk, the number 2 container carrier. It's a bellwether for global trade. I'm sure you know the company well. Basically, coming out with a very soft forecast for global demand. And Tom, saying that Europe is close to a recession and the United States is not far behind. That's the message from them.
Liz Ann Saunders, Schwab keeps a real eye on, I believe it's Shanghai to the West Coast, maybe Shanghai to Long Beach shipping rates, and they've plummeted as well.
What a change, though, from where we were 18 months ago, maybe even 12 months ago.
But then it comes back. I don't have a strong belief here other than to say the people like David Rosenberg don't get enough face time in this constructive debate. They are saying it is disinflation, it will be solved, and it will be solved sooner than people think. Witness the 2 inflation reports to the next meeting.
He's welcome here anytime. He knows that.
I just think in general the whole disinflationary crew has been pushed aside.
This cycle's moving very quickly.
It is.
And we all agree on that. And it's flipping the other way very quickly as well.
But that's the reason why I ask, has there ever been a time where the overlay of what the reality will be in 2 years has ever been less certain?
No.
I mean, I just wonder, because if you talk about that, the inflationary impulse was underestimated. And now the disinflationary force, some people are saying, is underestimated. And others are saying, wait a second, not so fast. The real economy is going to bite, and it is biting in a real way.
I'm more uncomfortable when everyone agrees. And on that point, I do wonder whether we start to see some dissent at the Federal Reserve in the next couple of meetings.
Does this market make you comfortable?
Right now, I'm more comfortable when we can have a conversation about the range of outcomes and we're not married to a particular view.
And that's also why some people are thinking that perhaps you get price discovery and you get some rationality into markets because they actually are expressing different views, which we really haven't seen in the past 20 years.
What is team fixed income? What do they all say? This is the market they want.
This is what they wanted. They're excited.
This is the market they want, and they hope This is the market we get to keep. Hope. Mike Gapen.
Circle the word hope every time you see it.
I hope Mike Gapen of Bank of America is going to join us shortly, Tom. I think he might. That's my forecast for the next 30 minutes. Futures unchanged on the S&P. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Federal Reserve looks set to deliver a fourth straight supersized interest rate increase today. Policymakers expected to raise rates by another 75 basis points. Meanwhile, Fed Chair Jerome Powell is almost certain to repeat his unwavering message on inflation without necessarily pivoting yet. Russian military leaders reportedly discussed using tactical nuclear weapons in its war against Ukraine. That's according to the New York Times, which attributes the information to senior American officials. Now, the Times says the conversation showed how frustrated the Kremlin has become over its setbacks on the battlefield. In Israel, the fifth election in 4 years appears ready to return Benjamin Netanyahu to power. Now, exit polls show that his strategy of forming an alliance with the nation's far right has succeeded. The pro-Netanyahu bloc appears to have just enough seats to form a slim majority in parliament. CVS, Walgreens, Boots Alliance, and Walmart have tentatively agreed to pay more than $12 billion to resolve thousands of state and local government cases involving opioids. The suits accuse the chains of mishandling the painkillers, which are blamed for 500,000 deaths in the U.S. over 2 decades. States, counties, cities still have to sign off on the settlement. And the shipping company A.P. Moller-Maersk is cutting its forecast for the global container market. The world's largest owner of container ships says demand will shrink as much as 4% this year. Maersk says another contraction is possible next year. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
We think that the Fed will be holding at that terminal rate of 5.25 throughout 2023, and then rate cuts could start in 2024. But don't look for the Fed to be the white knight it historically has been, riding to the rescue quickly and aggressively with rate cuts.
I've got breaking news for you, and it's not the ADP report. It's the fact that the market responded to it. Equity futures on the S&P negative about 0.1%. Seriously, though, with that ADP report, let's get across to Mike McKee. Morning, Mike.
Morning, John. Well, no help from ADP for Jay Powell and company. 239,000 jobs created in the month of October, according to the payroll processor. Interestingly, they say it's a mix in the shift of hiring. We saw a big rise in service industry jobs, particularly in leisure and hospitality, but goods producers lost 8,000 jobs, 20,000 jobs total lost for manufacturers. So a major change there. Mostly the hiring was at medium-sized companies. And the other interesting aspect of this from the ADP, which will be somewhat complicating for the Fed, is the rate of pay increases goes down. Now, people who are switching jobs still are getting double-digit increases, 15.2%, but that is down from 15.7%. And those who are staying in their jobs are getting raises of 7.7%. That is pretty much in line with recent months. So softening pay increases, good news for the Fed. Still strong hiring. Not sure how they're going to take that.
All right. Michael McKee, it's a new ADP methodology. How many reports do we need to see before animals like you trust it?
That's going to be a good question. We have to see and compare with the non-farm payrolls numbers each month. This is only the third one for ADP, and we haven't got much of a track record. But I don't also know whether trusted is even something that ADP is looking for in this case, because they're making it plain with this new survey that it is not a forecast of what we're going to get from non-farm payrolls. It is simply another data point. So on that basis, 239,000 jobs is what ADP counts, and I guess we stop there.
Hey, Mike, we're going to touch base with you in about 10 minutes, I think. We'll catch up with you at 8:30 Eastern Time. I don't even know if I'm going to do a market report off the back of this. Down 0.1% on the S&P. Not a major move off the back of this, TK. The bond market essentially unchanged too. They're minor moves. 239, the estimate 185. If you're looking for payrolls on Friday, the estimate right now in our survey, 196. down from the previous month, 263.
And to get to Friday is important because Friday still looks like a buoyant number. I mean, it's not a
Sure.
it's not a number Jerome Powell's going to be.
I think
happy
what you
with.
got right there in the equity market
right,
was a
right,
flavour of
right.
how this market will respond to an upside surprise, which seems to be good news. Tom, is what?
That's his favorite
Yeah.
saying. Bad news.
Loves
yeah.
it.
Good news,
I know.
bad news.
I was waiting for someone to say it. I was
Our
like,
good
melted.
news is
Coming
Michael
up.
Gapin's with
Yeah.
us, the chief U.S. economist at Bank of America. Thrilled he could be with us. He's from the University of James Bullard, also known as Indiana University, and of course with work at the International Monetary Fund as well. Thank you so much, Dr. Gapin, for joining us today. I want to cut right to the chase. You and I give Chris Lowe at FTN credit for this as well. There's a massive illusion to the American economy Jerome Powell faces today, and that is within the core equation, net exports are holding us up. How poor are domestic final sales?
So final sales to domestic purchasers, which would be GDP less trade and inventories, grew at 0.4 in the third quarter, and it was 0.2, I believe, in the second quarter.
Is that a recession indicator?
No, it would essentially be the Fed's soft landing, where growth is positive but not, still below trend. So the interest rate sensitive sectors of the economy, housing, structures, were really what weighed on activity in the third quarter. I think the inventory rebuilding cycle is also largely behind us. So yes, we got the boost from trade in the quarter, but it accounted for all of the growth in the quarter.
Yeah.
Underneath that, the economy is cooling down.
We've been talking about the lag time, right? The lag, the variable effects, the lag time that the Fed is watching right now. How long would you estimate it takes before the full effect, the dampening effect of the rate hikes that have been executed so far take effect?
The cumulative effect probably as long as 12 to 18 months. You see the initial signs of it maybe 6 to 9 months out, like we are now. The interest rate sensitive sectors tend to respond first. If financial conditions tightened in March and April, you'd expect by the third quarter of the year it's going to show up, and it is. The cumulative effect, it's got to matriculate all the way through the rest of the economy, 12 to 18 months.
How high does unemployment need to go to get inflation down? This is the number one question that these senators have right now. What kind of damage is this Fed going to do to achieve its ultimate objective of getting back to 2%?
So our forecast is that it'll be a little higher than the Fed thinks. We're up to about 5.5% is where we think the unemployment rate may go. The Fed, as you know, is looking at about a percentage point rise to the mid 4s. I'd say consensus is probably around 5. So somewhere between the 4.5 to 5.5 range seems to be what we're all thinking. The Fed, your point's exactly spot on. The Fed's saying we need to remove imbalances in the labor market to bring inflation down. That's a bit of a euphemism for we think the unemployment rate has to rise to better balance supply and demand. That is the number one question right now. We say a little more than others.
Your research was cited by Senator Warren. I'm sure you're aware of that. She put it in her letter to Chairman Powell. Bank of America expects that unemployment will peak at 5.6%, implying a nearly 2 percentage point jump in the unemployment rate over the next year and the loss of more than 3 million jobs. The question they're asking Chairman Powell, is this the price we need to pay? Is it worth paying this price to get inflation down? Now, I don't expect you to do Chairman Powell's work for him, but there is this line.
Well, you can if you want.
This line that he used in Jackson Hole, and I'd love to get your thoughts on it. He said a failure to restore price stability would mean far greater pain. Can you elaborate on that a little bit for us, Mike, how people understand what would happen if they didn't tackle this?
So the Fed's belief, I'm wired the same way, is to think that the economy performs best over the very long term when we're not spending an hour talking about where is inflation and where is it going. You want to remove that variable off the table. So low and stable inflation gets you the best macro outcomes over the long term. I think we make a mistake right now when we think, oh, the Fed's going to over-tighten and make a policy error. I think the Fed is saying, no. The policy error is not getting inflation down to 2%. Now, we don't know if we need a recession to get us there. But if we do, if that is ultimately what's needed, the Fed would say we should pay that price now because, to your point, waiting and paying it later, history says, well, we're going to have to pay a lot more. So we don't like to be in the position that we're in, but we need to remove imbalances in the labor market, and we think we need to get to that sooner than later. So the true policy mistake is not getting inflation down to 2. The mistake is not creating some pain in the labor market to get there, if that makes sense.
Do you know who's in their office right now, Tom? Chairman Powell making notes. for the news conference when you get asked the question.
What's great, I read the Senator Warren letter carefully. Senator Warren did not cite Mark Cabana. I don't know what that is about. He's citing Gapin, but not Cabana.
Well, Cabana does the stuff on the balance sheet. The balance sheet unwind, and
they're not in speaking terms.
Love me when I get back to the office.
Mike Gapin's going to stick with us. We're going to talk about
then fly somewhere else.
A lot more than just this economic data. The Treasury refunding announcement just around the corner too. We're going to catch up with Mike McKee on that. Looking forward to it. Live from New York, counting you down to that Fed decision. Futures essentially unchanged, negative 0.05% on the S&P. Heard on radio, seen on TV for our audience worldwide. This is Bloomberg. $60 minutes away from the opening bell, equity futures down almost 0.1% on the S&P 500.
Crushed.
Going into the Fed decision, yields unchanged, 4.036%. Very erratic today, Tom. Euro dollar 98.98. I'm trying to be calm. I just TK's been.
No, it's an odd meeting. I mean, we're trying to be calm.
It's working.
I'm zen.
I mean, what's your first question to Richard Clarida today? This meeting's a non-meeting. Let's be direct. And so with Clarida, you got to go.
I disagree. I completely disagree.
You got to go right to December, and that's where you go into the single mandate question.
A non-meeting. The floor is yours.
Well, first of all, it is perhaps not dramatic that they're going to raise rates by 75 basis points. It is dramatic to see the balance of risks, to see how they clarify what they potentially could do to offset this prospect of easing by lowering to 50 basis points in December. Are they going to, for example, what else are they going to do to make it a hawkish message? Because that's what they're going to have to do.
We have auction headlines.
We do,
We have to stop the show.
Well, for Mike McKee.
Auction
he
headlines.
insisted. He insisted. Mike McKee, what have you got, sir?
Well, the bond industry is going to care, and they are the biggest liquid and most liquid market out there. The Treasury is going to raise $96 billion in new cash in the fourth quarter. They're keeping the auction sizes unchanged, although they're going to have to start raising them, they say, in the month of January because the government needs to sell more debt. For right now, it's $40 billion in 3-year notes and $35 billion in 10-year notes, and you get $21 billion in 30-year bonds. The big news out of this, though, is that the Treasury is actively considering a program of buying back Treasury bonds in order to improve market liquidity and to make it easier for them to sell new bonds when they need to. The Treasury buybacks, if they happen, would be the first time since April 2002 when the government had a surplus and they wanted to keep access to the market. And this would focus this time on off-the-run treasuries, which is where the Treasury liquidity issues are right now. The end of QE means that private sector must buy more in terms of bonds, and banks don't really want to because of the supplementary leverage ratio and other reasons why it's harder to warehouse these things on their balance sheet. So the idea is you buy some of this stuff back, and then they'll have more money and more capital room to be able to buy the new bonds that Treasury needs to issue to pay for the budget deficit. The Treasury Borrowing Advisory Committee out with a statement today saying that in general, it seems like a good idea. It will be hard to implement, but we're going to take a look at it. And one of the things they want to know is how much do they buy back and how fast?
So, Mike, this is a technical operation, if it comes to pass, basically geared at the liquidity functioning of the bond market. How much, though, on a broader level, is this really highlighting the difficult position right now that the Treasury Department is in, selling 10 and 30-year bonds at these much higher yields and having to potentially increase the sizes of those going forward?
It is a difficulty, Lisa, particularly because there is a budget deficit that is ever growing that needs to be funded at the same time that the Fed has been raising interest rates. And it's something like $380 billion this year, or about $100 billion this year and $600 billion next year in terms of the additional interest costs. This is all accruing to the Treasury. So it is a problem, and they do need to do something about the liquidity issue.
Mike McKee, thank you, sir. Mike, thank you very much. I heard some people calling this QE. Did you see that a few weeks ago? I know, it's not QE. No. Anyway, Tom, essentially, I think we're probably going to go forward with this based on what the Treasury Borrowing Advisory Committee is saying? It sounds like we're probably going to go forward with some kind of buyback.
Well, my summary with it, because I don't know the details. Lisa, folks, is expert at this. But
phenomenal.
My summary of this is simple. We're doing it in a higher rate regime, which brings us to Michael Gapin, Chief U.S. Economist at Bank of America, with us today. How does a higher nominal rate, some form of real rate lifting up, change the Fed's dynamic with Treasury? Can our central bank or other central banks actually lose money because all of a sudden they have an interest cost?
No, well, no. I mean, yes, technically the Fed loses money because it's paying out more in interest on reserves than it's earning on its securities holdings. So what it does is it just stops remitting those profits back to the Treasury. But does it lose that money over the long term? No. What it does is it'll recoup that loss later when it's earning more on its securities than it's paying out on interest on reserves. So it's what they would call a deferred asset, which is a great thing to be able to do on your portfolio. So they just stop remitting to the Treasury for a while, and then at some point...
Sounds like a 23-year-old trying to borrow money from dad.
I think this is a hedge fund's dream, Tom. If you could run money like this,
exactly.
Unfortunately, no one else can. We are thinking about the balance sheet and where that's going.
Mm-hmm.
QT has been a big part of the conversation. In fact, some might say it hasn't been a big enough part of the conversation. Is it something you expect to continue through 2023 alongside this call for a recession next year?
We do. I mean, we have the first rate cut in December of 23, but for practical purposes, yes, over the remainder of the year. And when you'd start cutting rates, you'd stop quantitative tightening. We think that the Fed, in conjunction with Treasury, can support market functioning enough in order for the balance sheet runoff to continue. So yes, we have it continuing for roughly a little over a year from now.
So is this the market functioning kind of surgery that needs to happen to make everything run relatively smoothly through this whole process, given that we're not yet in the heart of the lag effects of raising rates? We're not in the heart of what the consequences really are just yet.
Right. It's not, the Fed's not in the business of shutting down markets, right? And obviously you want the Treasury market to function. So if the Fed and Treasury need to do some things and buybacks and other things on the side to keep liquidity flowing and Treasury operations and the market functioning, that's what they should do. It's a difficult communication, right? Because on one hand, they're trying to smooth functioning, which may involve buying bonds. On the other side, they're trying to raise rates and run the balance sheet down. So it complicates the communication, there's no question, but I think they can manage it.
It complicates the issue on an international level as well. And Tom has been talking a lot about swap lines and this concern about the lack of dollars in a lot of different places. At what point will international strains become relevant for a Federal Reserve that has been laser focused on the U.S. economy and on inflation?
I mean, typically after they happen, if you know what I mean by that, meaning the Fed is doing what it's doing. Other central banks are doing what they're doing. In periods like this, when the dollar rallies a lot, yes, historically, stresses have popped up somewhere in financial markets globally. Knowing where those are in advance is always hard to pin down. And typically, the Fed and other central banks don't respond to them until you see it materialize.
I've got to ask you an international question with respect to Ethan Harris, who's wonderful, and that is with your IMF history, how fragile is EM right now? Do you wake up feeling comfortable about it versus the joys of the 90s?
More so than certainly the 90s. So emerging markets have made tremendous strides in the last few decades in terms of their debt management capabilities, the amount that they're borrowing in foreign currency versus domestic currency, the development of local currency bond markets. I mean, there is a narrative that EM has performed better in this tightening cycle than many had expected.
If we get persistent dollar strength, how does that change the narrative?
Well, at some point, stresses in the system would build, but whether that would show up in emerging markets or what has been the case presently, more market functioning in developed bond markets, we would have to see.
Final question. December rate hike call. What is it now?
50.
50. The step down, Tom, from 75 later to 50. Mike, this was fun. Thank you, sir.
Thank you.
It's good to see you. Mike Gapin there of Bank of America, and to Senator Warren, sitting at home, who I know often watches. Mike Gapin answering some of your questions for you. Tom.
It was, yeah. And you know, again, this is serious for people that are against progressives in Congress. This was an adult letter. This was really written well with footnotes. It was a really strong effort.
If you park the political motives,
yeah, exactly.
And just look at the substance.
Why can't we get more letters like this, frankly?
I thought they were pretty decent questions to be asking.
I'm still laughing. It was an adult letter. It had footnotes, you know. I mean, it was because of the substance of it. I mean, it wasn't just,
this letter was not blah, blah, blah.
Look, it highlights this tenuous moment, and there is merit to both sides of this discussion, right? How much do you have to break the economy to bring inflation down? We don't know. The Fed doesn't know, and they concede that. Economists don't know. The consequence, though, of inflation running hot for a very long time is severe for the economy, and because of the surprise to the upside, people are very worried.
Do you think he's for or against daylight savings?
I think he's anti. I think everybody is anti.
Think everyone's against?
Just the
Maybe
shifting
I've got a question in
times.
that presser today.
Abramo feeds Mike McKee's questions.
Yeah.
Yeah.
How do you feel about daylight savings time? I think that'll go
That'll
well.
start some headlines.
Do you get El-Arian in your hour? We don't get El-Arian early
in 20
because
minutes.
he's teaching Western Civ at Cambridge
That's
or
not
something?
the reason. That's not the reason.
Yeah. I
He
mean,
just doesn't like you.
we just, you know,
He
we
told
get
me.
no love from El-Arian.
I know, because he doesn't like you.
Oh, okay.
You've never watched his football team, QPR.
I watched once.
And what did you learn about QPR?
I love their stadium. It's like Ted Lasso. Yeah.
Did you?
It's like they're like, I like the little stadiums.
Oh my God.
Like versus the tots.
Yeah.
I mean, I like. What do you? I mean, most of those stadiums are like that, right?
Just seeing if he's messaged me about joining a little bit. No. Anyway, coming up at the Open, Mohammed Al-Arian of Queen's College, Cambridge, Kathy Jones of Charles Schwab, Bob Michael of
very
JP
good.
Morgan Investment Management, and Alliance Bernstein's Gershon Distenfeld. These are all the people, Tom, that just don't fancy on surveillance.
No, they don't.
And they're going to join us in the next
But it's
hour.
Fed Day, really, it's like straight through to the show. We've got some wonderful
Straight through to
conversations
the
about this to
Fed
get to
decision.
December.
Are you prepped and read in for the step
I
down
am
chat?
so read in. I'm all stepped down.
Bramo went through our lineup for the Fed show. It's phenomenal.
Yeah.
Can we say thanks to the former Fed Vice Chair, Rich Clouder, for making this a regular appearance?
Very
How cool is
special,
that?
good half-hour
That's incredible.
conversation.
We made him commit to it last time around, and he's followed through.
Yeah.
I think that's brilliant.
Yeah.
Does he realise that he's contracted now for the next 12 months?
See my bow tie today?
What's
Columbia
that about?
University. This is a gift to Ned Phelps.
Very cool. Coming up, Scott
There it
Minard,
was.
Matt Lazzetti,
Yeah.
the wonderful Diane Swank, who said, I have to say straight out the gate, a number of months ago when we got forecasts from the Fed, she called them fanciful.
Yes.
Fanciful forecasts. I think Scott Minard said it was fantasy land. I wonder if Rich Clouder agrees. He'll be joining us a little bit later. From New York City this morning, good morning to you all. Equity futures shaping up as follows. On the S&P 500, equity futures are going absolutely nowhere. Totally unchanged this morning and unchanged since the day before the Fed last met on the S&P. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The man who killed 17 students and staff at a Parkland, Florida high school will be sentenced to life in prison today. Nicholas Cruz pleaded guilty to the 2018 attack last year. Last month, a jury decided against the death penalty and chose a life sentence without the possibility of parole. A judge will formally sentence Cruz today. It's decision day at the Federal Reserve, and for a fourth straight time, policymakers expected to raise interest rates by a supersized 75 basis points to the highest level since 2008. Meanwhile, Fed Chair Jerome Powell is likely to stick to his message that the hottest inflation in 40 years must be tamed. Bloomberg's learned that the U.S. and Saudi Arabia have shared information indicating that Iran may attack the kingdom or other nations in the region soon. That's leading Washington and Riyadh to adjust their military posture. People familiar with the matter say the attacks would be an effort to distract from the recent nationwide protests in Iran. The state of Washington has sued Albertsons to stop the grocery chain from paying $4 billion to shareholders as a special dividend. Albertsons and Kroger are being accused of going against antitrust consumer protection laws in their potential merger. The state's attorney general says a payout before regulators can review the agreement will weaken Albertsons' ability to compete. And shares of Airbnb are falling after the company gave a disappointing outlook for books in the fourth quarter. Now, that suggests consumers are shifting away from the higher cost rentals that thrived during the pandemic. The muted outlook comes after Airbnb recorded its highest revenue and most profitable quarter yet over the summer. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
we are still losing several hundred people, 300 to 400 people a day to COVID-19. And they tend to be predominantly individuals who are not up to date on their vaccines or who haven't received treatment. So we still have more work to do, and especially with the winter coming, we've seen the last couple of years there's been an increase in cases during the winter. So that's why we want people to be up to date with their vaccines.
David Rubenstein will speak with the Surgeon General of the United States, that is Vivek Murthy, and he joins David here for a peer-to-peer conversation. Look for that at 9 p.m. Tonight. Mr. Rubenstein joins us right now on this most unique physician. David, what I love about Dr. Murthy is 20 years ago at Yale, he basically invented something called healer's art. He seems to have been a generation ahead on the mental health challenges that we have all lived in a pandemic. What did you learn about him, about the persistency of the challenges we face?
Well, he's very concerned about the mental health problems that our country has coming out of COVID, and obviously for school children as well. And he's also concerned about the isolation many young men have and the mental health problems associated with it. And we've seen some of that recently, obviously. So he's worked hard on that. The Surgeon General of the United States is a position that is not known to a lot of people about what it actually is. It's a position where he's designed to talk about healthcare issues, advise the president, and oversees 6,000 healthcare professionals around the country. He's been the Surgeon General under President Obama, and then to his surprise was reappointed under President Biden. He's the first person to do it twice under two different presidents. He's a very talented person, the son of immigrants from India, grew up in Florida, valedictorian of his class, went to Harvard, Yale Medical School, very, very talented person.
What does he say about COVID? He mentioned there in the comments it's still germane, but have we deluded ourselves that COVID is over, under 400 deaths per day?
Yes, you've got 300 to 400 deaths per day, and these people who are dying, his view, because they're unvaccinated or they haven't kept up to date with their vaccinations. So I just came through COVID myself, and first time I had it, and I'm up to date on my vaccines, but I probably could have gotten a booster more readily than I probably did the most recent one, but maybe that's why I got it. But his point is that people are not vaccinated at all. They are really in danger of being one of the 300 to 400 a week who are dying. And so we're not completely out of the woods here, in large part because about a third of our country doesn't want to be vaccinated.
Well, and David, I'm glad that you're feeling better. And a lot of people have been going through it right now. Just pairing the two ideas that we just have been through a pandemic that caused real fissures in the social fabric that have exacerbated some of these mental health issues. Did Dr. Murthy talk about that, about how the pandemic and some of the responses really did exacerbate the mental health problems in the nation?
Yes. What happens is when you stay at home, you think, okay, I'm going to be safe, but actually you are deteriorating your ability to relate to other people. And ultimately, for many people who become so isolated, they have mental health challenges. His biggest concern is the mental health isolation right now in the country. There are a lot of healthcare problems, obviously, opioid addiction, cancer, a whole bunch of other problems. But right now, his particular focus is healthcare, mental health. And that's something he's focused on his whole career.
Yeah, with respect to loneliness, really, and what that does to people as well. I'm wondering what this says with respect to any kind of response from a government like the United States to additional pandemics or other health problems, if there is this add-on of the mental health component afterwards, which could be just as pernicious, if not more so, certainly in certain communities and among certain kids who are actually having to re-socialize going back to school.
Yes, you don't really know what the impact is going to be until much later. In other words, if you get COVID, you can see the impact right away. But if you're isolated and you have a mental health problem, you might not pick that up for 4 months, 5 months, 6 months, and you might not get the kind of treatment you needed. And one of the things he points out is that mental health problems don't get reimbursed by insurers or the federal government in quite the way that physical health problems do. And so there's certain stigma associated with mental health. There always has been, but the stigma hasn't gone away, and the insurers still don't reimburse you for mental health treatment that you might need.
David, is the Surgeon General job, if you will, is it political? Do they just try to find somebody with major chops in medicine, or is it a political football from Republican to Democrat to Republican?
Well, I wouldn't say it's a political football, but I would say that you need to be a healthcare professional, but clearly you are appointed by a president and you're confirmed by the Senate. And the first time around, when he was appointed by President Obama, he had a difficult time being confirmed because he had said that there was a problem with guns in our country, and that was seen as a healthcare problem, and many people didn't want to confirm him for that. He did get confirmed. This time it wasn't so complicated. I would say nothing in Washington is apolitical, and I would say there's still some political nature to it. Honestly,
David Rubenstein.
Unfortunately.
Well, thank you so much, David. Greatly appreciate it.
Thank you.
Carlyle Group, the co-chairman, and of course the host of the David Rubenstein Show. Peer-to-peer conversation here on medicine and something gripping all of us, regardless of our politics, the mental health of the nation. The Surgeon General, Vivek Murthy, with David Rubenstein. Look for that tonight. Lisa, we've got to frame up where we're going to be in a number of hours. And I was saying, like, okay, it's a setup, 75 beeps. They've got to do it. But to the point, as we heard from Dr. Gapin of Bank of America, December's wide open right now. I mean, wide open.
Well, and how do they signal some sort of step down, which I know you love, while not letting the markets go to town and really just get away from themselves and rally tremendously, right? I mean, this is going to be a tricky meeting. You say it's a non-event. There is some credence to this idea that they don't have any visibility into the rest of the world. And so they raise 75 basis points, say, we don't know, and then we go about our merry way. But there is a question of how they try to message a step down while still being hawkish.
I think he's got a message also why the markets and the sum of the Bloomberg Financial Conditions Index clearly signals a more accommodative space than where we were 2 weeks ago. I don't think that's a small moment.
But this is the same point that we're talking about, right? This idea of how do you lead to tightening financial conditions while also signaling that they're going to slow the pace of rate hikes because there's only so much that you can do before you potentially cause damage that you don't even realize until later.
Amy emails in and Amy says, ask her a question about the debt announcements an hour ago because it involves auctions. Are you going to review what McKee was talking about half an hour ago?
You know, it's a technical kind of trying to ease some of the liquidity and some of the less liquid instruments. I was actually focused on something else, to be honest, in the break. I was looking at something that you were talking about, which was the Egyptian pound. And you were talking about the potential for wheat disruptions.
Right.
And Egypt came out and said that the Russia-Ukraine crisis is costing Egypt 20 billion Egyptian pounds more in bread costs. That's about $840 million worth with additional costs for the price of bread.
I had an extraordinary conversation with El-Sisi in Davos a number of years ago. A really, hugely controversial but very unique individual. He has COP27, which I believe the Prime Minister will attend now, Mr. Sunak. He's got huge food challenges and a massive devaluation from the stability of the Egyptian pound. His plate is full into the end of the year. We look to 1:30 this afternoon. We are so honored that Richard Clarida will join us of Columbia, the former Vice Chairman of the Fed, and other worthies. Stay with us. It is Fed Day.